I'm going to make sure I can hear myself right now. Anyway, Becky, Andrew, Joe, let's take a look at some of the big pre-market movers so far. We'll start off with an aftermarket movers from last night, but it's going to have an impact on that semiconductor trade so far this morning. We're talking Broadcom shares. They're up roughly, 7% right now, just about 5,000 to 6,000 shares of volume after the computer chip company comes out with better than expected results for both profits and revenues. It also gives a current forecast for the current quarter revenues that implies a more upbeat demand for its products out there, servicing 5G wireless, data centers, that sort of thing. It also announced a new $10 billion stock buyback program. So the Broadcom shares, yes, are up 7%, but it could have a sentiment ripple effect on other parts of the semiconductor business as well. So we'll watch those. And then an analyst downgrade today that's hitting a well-known name, Peloton shares, right now down about 2.5%. Big down day yesterday. They've lost about 3/4 of their value over the course of the last year. This is being helped in part by Credit Suisse analysts who've cut their rating on the stock from an outperform to a neutral. They've also more than halved their target price from 112 all the way down to 50. They cited things like changing consumer spending patterns on more reopening type activities. Also some of the headwinds that are going to come about because of in-person fitness returning back again as we kind of emerge from COVID. So Peloton shares weaker this morning, down about 2.5%. And then a check really quickly on the cryptocurrency side of things as well, because we kind of float right around that 50,000 mark for Bitcoin prices. We're up about 3% right now, just shy of $49,000 per coin. Ether prices right now up about 2%, 41.82 the last trade there. And then Coinbase Global and MicroStrategy both unchanged in the pre-market, but we'll watch those on the heels of any kind of move, Joe, on what happens with Bitcoin prices. I'll send things back over to you.
So many things in hindsight. When we see them, Dom, it's like, duh. But $150 for a company that makes exercise bikes. I mean, did anyone ever think about that? And you reopen, and for me, if I don't have someone like telling me I got to do something, I'm like, I'd rather watch TV, you know? So, I mean, it helps to go to the place. And we should have known when Planet Fitness or Lifetime, that was going to happen. And look at that.
Just like Manhattan real estate, right? We knew that was going to happen as well.
Dom, yes. Do you have a screen or a filter for inflation sensitive or inflation beneficiaries for, like, are you ready for this number? Will you change what you do for the rest of the day based on what we see?
So yes, we do have a number of screeners we watch, and specifically, I got a lot of different screens on my desk right now. And we kind of put together some of those typical lists that we'll watch, the types of stocks and the types of assets that we'll do based upon certain types of moves. I know that we're going to have some market movement based upon the inflation numbers if they come out. So there will be possibly later on today more of those types of stocks that we talk about, maybe materials oriented or maybe gold related stocks or consumer staples names or anybody else who might be affected by those types of inflation prints. So we'll have all those things.
All right, thanks, Tom. This isn't what I was trying to show, and we don't need to go into this, but that was the one I was trying to show. Are you serious? In red. You hadn't seen that, had you, Becky? Someone thought I was trashing the Giants. I wasn't doing anything about the Giants. I picked up the wrong tabloid. It happened.
It does. Go Rutgers. Markets and investors anticipating the highest inflation reading in nearly 40 years. And the latest CNBC All-America survey showing a shift toward Republican control of Congress amid some of the big issues facing the economy. Steve Leisman is here. He's been running down all of this, and that number is less than an hour and a half away, Steve.
Yeah, and it's a political number and an economic and market number, Becky. But amid growing worries on the economy and COVID, what we show is that President Biden's approval rating in both areas taking another hit, while Americans' preference for congressional control swinging sharply towards Republicans. Biden's approval rating in the CNBC All-America Economic Survey stabilizing at a very low level of 41%, about the same level as former President Trump. That compares to 50% who disapprove. But his approval rating on handling coronavirus dropped to 46% to 48% disapproving. That measure is now underwater for the first time for the president. His economic approval rating sinking more deeply underwater, with 37% approving compared to 56% who disapprove. That is also worse than the last survey. The polling data for Democrats in Congress, even worse. Republicans now sport an historic 10-point advantage on congressional preference. 44% want Republicans to run Congress and 34% prefer Democrats. That's up from a 2-point Republican advantage in October. In the past 20 years, CNBC and NBC have never registered a double-digit GOP advantage on congressional preference. Democrats lost ground in critical areas that help put Biden in office. Residents in urban ring counties, those who favored Biden in 2020, now prefer Republican control of Congress. The Republican advantage in outer suburban counties doubled from the 2020 vote. You can see that they're on the right side of your screen. Now, our Republican and Democratic pollsters tell us with an off-year election usually leading to losses for the incumbent party, the question here is not whether Democrat losses will be bad in November. It's whether they will be historically bad. Becky?
Yeah, especially with such a tight split right now. What is it? 3 seats? It was 5 before, but there have been some changes in some of the races. So you're talking
there was
super
changes,
tight. Super tight on both of these
It's already
counts.
very tight, and there's a historical trend towards the incumbent party losing. And now, I mean, when you dig into the details of this survey, it could not be better for the Republicans or worse for the Democrats.
Does it match up against anything you've seen before in this survey?
No. I mean, well, look, President Trump's numbers were bad, but they were sort of stable bad. It was like a, what do you want to call it? Like a law of physics. His number, the worst scandal would come out and his numbers didn't change. They were low. And his economic numbers were kind of constant. But this one is sort of a straight down. We'll see. I tried to look back at the greatest presidential turnaround, and I think it might have been President Clinton in the 90s, but that still led to losses in the ensuing November election.
That's what I was going to say. We do have some time before Election Day. And if you listen at least to conventional wisdom, some of the people who know, maybe we're hitting the peak of some of the issues when it comes to the supply chain, at least. I don't know about inflation at that point, but maybe things improve between now and next November.
There's an interesting debate among our pollsters. One of them thinks that what they need to do is get COVID under control, and then everything else follows from that, getting inflation under control. The other one thinks it's more about the economy and getting inflation under control first. I wonder, though, with the public having made up their mind about Biden, can they change it? He came in with this promise of getting COVID under control. I don't know that what's happened has been his fault, but certainly it's on his watch that we've had not really gotten that much better in terms of COVID and having another wave. We had the Delta wave, and now we've got perhaps this Omicron thing. So I don't know that people change their mind and say, oh, wait a second, maybe he was really good about COVID. Maybe he was really good about the economy. What is interesting to me, Becky, doing all this polling, the economy, the growth numbers are pretty good. The jobs numbers are pretty good. But inflation just is like I don't want you to call it, but a cold shower on all of that data. While inflation goes up, people are going to feel really lousy about the economy. So maybe that can be turned around if inflation is brought under control.
We'll see. Steve, thank you.
Pleasure.
Okay. Coming up in just a moment, from pay to vaccine mandates, PwC's U.S. chairman and senior partner Tim Ryan is going to join us to talk about returning to the office and what work is going to look like in 2022. Before we head to a break, though, take a quick look at the markets. We are up across the board, 56 points higher on the Dow. NASDAQ looking up a little, about 32 points higher. S&P 500 up about 11 points right now. Squawk returns in just a moment.
CEOs going into another new year faced with challenges of getting workers back into the office. The latest surge in COVID cases and the rise of the Omicron variant has several major companies putting return to work plans on hold. Joining us right now to talk about the future of work is Tim Ryan, PwC's U.S. chairman. And Tim, this is something I think most of us thought by this point would be cleared up and we'd kind of be back to normal. That hasn't been the case. What are you hearing from the CEOs you talk to right now? Will they be bringing workers back in January?
Yeah, Becky, it's good to see you. Good morning. What I would tell you is we thought in the summertime we'd be back, and then Delta variant hit. It certainly is causing companies to be agile, but I think at this point we are seeing more and more people coming back. We're seeing numbers go up with people coming back in this fall, and companies are moving forward. They've taken extraordinary measures to keep workers safe, but also we're seeing leading companies give choices as well, recognizing that different things mean different things for different people. So I think agility is the name of the game, but companies are becoming more comfortable with the ability to keep workers safe. So I do see people coming back in January, and we've already seen that over the last 3 or 4 months.
You at PwC have announced that lots of workers can actually work from anywhere they want at this point. I think you'll have probably about 40,000 workers who are working remotely. Is this the new normal that's here to stay, or is this the situation that once COVID kind of fades back and once maybe you have a less tight job market, that things kind of revert back to what we were used to before?
Yeah, Becky, what we're seeing is CEOs and leaders, including us at PwC, we're thinking differently. And what it really is important is we're seeing CEOs realize that it's less about where people sit, but it's, do you have their hearts and minds? Like, do you have their mindset? Are they really excited about doing the work? And in our case, serving clients, and other cases, innovating and the like. What we did at PwC is back in September, we gave every employee a choice. And we said, you tell us where you want to work, because frankly, we were guessing what they needed and we were trying to meet their needs. And it was, to be very frank, uncomfortable. We weren't sure what we should do, but we made the decision to give our employees the choice, which many of us, including me as CEOs, were worried about doing. What was remarkable is when we gave them the choice, 22% said they would prefer to work remotely permanently, but 78% said they want to come in. And that's a little bit counterintuitive, I think, what we're hearing. So for an organization our size that's imminently manageable, you can give your employees what they want, which builds trust, which then makes them feel better about the work environment, allows us to do better work with our clients. I'll just share with you one more data point. When we made that announcement that people could have their choice, and again, 78% said they want to come in, and they've been coming in the last several months. We also saw our job applications for virtual work go up 35%, and it's in the hottest areas like cyber, digital, cloud, and the like. So the fact that we're giving choice, we're seeing more and more talent want to come to the firm. I'm seeing more and more thinking evolve in that way across the corporate world.
Well, let's talk about that, because Google, we have audio from a meeting where they were basically saying not everybody's going to get a raise next year to keep up with inflation, that this is going to be done based on those workers who are performing at their best. And maybe that's counterintuitive to what you would anticipate hearing right now when you have such a tough labor market and when you have inflation at the highest levels we've seen in nearly 40 years. Is that what it's all about, though? If you are feeling like you are catering to your employees' other needs, you can give it away without having to do massive pay increases to keep them.
Yeah, what's been very clear is employees have said they want a lot of things. Financial rewards are hugely important, but also the work environment, where they want to work, the flexibility is also important. I view this as not an or strategy. It is about both. Clearly, organizations that have the most competitive pay will win the best war for talent. But if they don't allow employees the flexibility of how they want to work, pay by itself is not a distinguishing factor. We're seeing that both. We see that in our client base, and we certainly see it here at the firm as well. And we're seeing more and more organizations think differently around when you build trust your employees, part of that trust is where letting them work where they want and letting them get the work done the way they want. But also when they are working remotely, creating an environment for those who are in the office at client sites where they can be inclusive. That is also a massive opportunity of differentiated, in addition to just money as well.
Tim, call me a cynic, but I keep coming back to this idea that employers, and I'm not talking about PwC here, but broadly, the CEOs you talk to and what you hear, I get the sense that, okay, We're going to let you guys do this right now because we really need the help and it's a really tight labor market. But again, I would prefer you're here in the office. And once the pendulum swings the other direction and employers have the upper hand again, I get the feeling that some of this is going to get rolled back. Do you agree with that or no?
Yeah. So what I appreciate the cynicism. What I would say is we're in a major experiment right now. But Becky, here's what we knew to be true before the pandemic, and I think it'll be true after the pandemic. When employees are feeling the best about themselves, they do their best work. And that was in place before the pandemic and after the pandemic. And at the end of the day, what CEOs really want is they want employees who are happiest, healthiest, because they do the best work, whatever that work is. And I think you'll see leading organizations stick with flexibility that's been gained over the pandemic. And I'm certain there'll be some that go back as quick as they can when the balance of power shifts. But ultimately, it'll come through in the value those organizations create for their customers. And I personally believe in, as I've looked at leading companies, when you have happy, fulfilled employees, they do great work. And so we'll see how it plays out.
One of the huge questions for the markets right now is, are companies going to see their margins shrink? Because stock market's been doing fantastic. Companies have been able to maintain their profit margins even in the face of all of this inflation, whether it's coming from wages or input or shipping costs, things along those lines. What are companies going to do next year to try and contain costs? Does it come on the salary front? Does it come on the travel and entertainment front? Is this how are the companies going to get through this and try and maintain their margins?
There's no doubt one of the big issues going into 22 is the ability to pass on cost increases, whether that be through supply chain, shipping, other types of costs, labor costs, and the like. It's on the minds of everybody. The cost, the price, ability to pass it on is on everybody's minds. But that is spurring amazing innovations. Companies are becoming more automated, more digital. They're simplifying their processes, and that allows them to keep up. It used to be a good thing to do, and now it's absolutely necessary. So what I expect in 22, especially if there's pressure on passing price on, I expect companies continue to drive massive innovation and automation, everything they do. And we're seeing that across the corporate world right now as companies look to gain more productivity. There's been a lot of productivity gained over the pandemic, but there's a long way to go. And that will allow companies, especially those who do it well, that'll allow the ones who do it well to continue to deliver good financial outcomes and buffer against the inflation that's out there.
Hey, Tim, I just wanted to ask about what I call proximity to power. How you think employees, especially employees that are not established, how they establish themselves if they're not going to be in the room with the boss.
Yeah, Andrew, it's good to see you. What I tell you is that we all grew up a certain way, and the way we grew up worked for us. At the end of the day, that is still very important, but there's other ways to do that virtually as well. So I don't view this as an all or nothing world. And I'll go back to 78% of people will be coming to the office, but for the 22% of our people who have said they want to work remotely, we're now creating new ways to get proximity. I'm spending more time with those groups. Our leaders are spending more time with those groups in different ways that we did before. So I see it evolving. I do think proximity is important, but it doesn't necessarily have to be physical proximity. It can be virtual. It causes leadership to do something different. And in my view, those who will succeed will be the CEOs who are willing to pivot the way they did things to meet the needs of multiple groups of employees going forward. So that proximity, that coaching, that mentoring is still important. It just may not be done in a physical hallway the way we did it growing up. It may be done over virtual in a very different way. And again, adaptability is critical here. The old way worked for us, but leading organizations are thinking differently these days. If I can, Andrew, just one quick thing. We launched back in November a Trust Leadership Institute. The reason we launched that institute, and we're taking 10,000 current and future C-suite leaders through that, including 50% women and diverse leaders, is to think differently going forward in the world where trust is so important. And one element of that is trust your employees. Can they succeed? Can they grow in their organizations? And how do you do that in different ways going forward? So it's critical that we think differently about how do we build trust, because trust will build better performance.
Tim, great to see you today. Thank you.
Coming up, workers at a Starbucks location in Buffalo, New York, are notching a win Thursday and forming the first union at a company-operated Starbucks store in the U.S. Will other stores now follow suit? We'll discuss. And we're watching the shares of Costco. The company's revenue jumped by 16.5% and beat analyst estimates. Same-store sales rose by 15%. E-commerce rose by 14%. Costco executive said the company is weathering supply chain issues and inflationary pressures better than most other retailers, thanks to earlier ordering. Squawk Box is coming right back.
Time now for today's Aflac trivia question. What was Walt Disney's first feature-length cartoon movie? The answer when CNBC Squawk Box continues. Now the answer to today's Aflac trivia question. What was Walt Disney's first feature-length cartoon movie? The answer, Snow White and the Seven Dwarfs, which was released in 1937, 3 years after production started.
Welcome back to Squawk Box this morning. Workers notching a win at a Starbucks store in Buffalo, New York, voting in favor of forming a union. Now, Starbucks won at a second location, and the third store's results inconclusive due to challenges. Kate Rogers joins us with the latest on what it could mean for the coffee giant and others. Kate.
That's right, Andrew. A win for workers at that one Starbucks location in forming the first union at a company-operated Starbucks store in the United States. Now, Starbucks prevailing at that second location, as mentioned, which the union may contest, and the results at a third store are pending due to unresolved challenges. Now, while the ability to unionize is progress for Starbucks Workers United, the group does admit there is a long road ahead. It's hopeful that Starbucks will come to the table to negotiate and agree to a contract, which it does not have to do.
If we are able to negotiate for a better contract here that makes our lives better and negotiate better benefits, a better benefits package, better wages, whatever it may be, the company has the resources when our CEO is making $15 million a year to provide that across the company.
Meanwhile, Starbucks EVP in North America's Rossann Williams told partners in a letter after the vote that the results are preliminary and do not change the company's shared purpose with its workers. And there will certainly be more important decisions to come as 3 more stores in Buffalo and 1 in Mesa, Arizona are all seeking to unionize, with more to come from the NLRB in the weeks and months to follow. Now, as for the broader restaurant industry, this could be an important development. MKM Partners writing Thursday, quote, "If this move creates a tailwind for other concepts to see their employees follow suit, we do believe Starbucks could be among a handful of scaled concepts better able to absorb these higher costs." Andrew, back over to you.
So what comes next for Starbucks in particular in this union? When do the votes get certified? When do we find out what really happened there?
Sure. So both sides have until December 16th to put in any challenges. As mentioned, the second store that Starbucks won, the union did claim that some votes were missing there, but the count did end yesterday. And then there's that third store with 7 challenges that could go for either side if they do get resolved. So they have until the 16th to put in those challenges. After that, they'll be certified. But either of those 2 that are contested could wind up going to a hearing. So this could take a bit longer. But importantly, the first store, the Elmwood location that did go in favor of the union, it doesn't look like Starbucks will be challenging that one, Andrew.
Kate, I have to admit I'm a little confused by this. What is it that the union wants, that the employees there are saying they want, that they're not getting right now? Because I've always thought of Starbucks as, being a pretty decent place with pretty decent benefits to go along with it.
Becky, that's a great point. They are among the most progressive in the restaurant industry, and they long have been, right? Their wage floor is increasing again in the next few months. By summer 2022, I believe most workers are going to be above $15 an hour. So that is an important point. These workers at this particular store and at those 3 stores said that conditions had worsened over the course of the pandemic. They were really short-staffed, claimed, that management wasn't listening to them and that they needed help. Management has been on the ground for several months, listening to their concerns, working to fix it, saying that they hear and understand why that these workers have been frustrated. But the workers say that they want a seat at the table with Starbucks to better negotiate a contract. Starbucks doesn't have to agree to a contract, but it is notable, that they were able to form this union and obviously caught the attention in a very big way of management.
I guess it speaks to some of the frustrations of the pandemic and things getting fast forwarded. Andrew, sorry.
Hey, Kate, if they don't agree to a contract, what happens then?
I think they have about a year to figure that out, right? And if they don't, then they did get the attention of management. The union was formed, but they won't wind up necessarily getting what they wanted in the end, which is to actually agree to that contract.
How much are union dues?
I don't have that answer yet.
Kate, thank you. We appreciate it. When we come back, Dr. Kavita Patel joins us to talk about the latest on the vaccine front and the possibility of having to get a 4th shot sooner rather than later. And check out oil prices right now. WTI up by about 1% this morning, $71.66 a barrel. We'll be speaking to Goldman Sachs Global Head of Commodity Research in just a little bit about this sector. Squawk Box will be right back.
Welcome back to Squawk Box. There you can see the three averages we follow. You really need to segment these after what we saw on the NASDAQ yesterday versus what happened in the Dow. So it certainly isn't just one market that we're talking about. The S&P up about 10. Today it is. Dow Jones, at least now, we got a big number coming out in a little less than an hour. Dow up about 60, and then the NASDAQ indicated up about 17 points.
Let's talk a little bit about the CDC for a second, because they're now recommending booster shots for anyone 16 and older to broaden the protection against the new COVID-19 Omicron variant. Joining us now with more is Dr. Kavita Patel, fellow at the Brookings Institution, former White House Health Policy Director. She's also an NBC and MSNBC medical contributor. Good morning to you. It appears to be rolling out boosters as fast as humanly possible. The question I'd ask actually about the booster at this point is for those who are within this window right around 6 months, but maybe even at 5 months. I know people who are saying, should I be getting the booster now?
Yeah, Andrew, it's a very common question, because I've been seeing some patients trying to sneak in at about 4 months even, thinking that kind of sooner might be better. I've been trying to discourage that, just because we don't know kind of what leads to the next shot. You've already heard the Pfizer CEO thinking about or alluding to a fourth shot sooner, maybe than 12 months even after a third dose. And the whole point of timing these vaccines is to kind of encourage optimal immunity. So unless you have, I have seen some doctors, I haven't done it for my patients, but some people who never really mounted that initial response, older patients with other conditions, that some of those people have been receiving boosters a little sooner, kind of on a case-by-case basis. But in general, we're trying to stick to the schedule so that we can keep people evenly immunized throughout and even beyond this period after the third dose.
We just did a segment this morning about return to work, the idea that there was going to be even more return to office taking place in January. How does the new variant change or not change that dynamic from what you're starting to see in South Africa and maybe some of the numbers in the UK and elsewhere?
Yeah, I'm already talking with employers of different sizes in the United States who are rethinking their mask policy. Most employers had if you're fully vaccinated, hadn't included a booster in that definition, Andrew. So I think that's critical. But if you're fully vaccinated, then you don't need to wear a mask. And that's been a pretty common theme. And I think that's also kind of resonant with what I would expect as somebody who's immunized, that I'm safe. I've seen a lot more employers now putting masks back in. They've also been moving a lot more of their larger gatherings back to Zoom, kind of taking that virtual posture for anything that involves more than, say, 5 or 6 people. And then I think third, a lot of people are reconsidering, hoping the CDC will take action first, but reconsidering the definition of fully immunized to include that booster dose to provide that extra protection, in the hopes that masks and other mitigation procedures could come off soon.
Does that change the dynamic for you? Meaning, if you were to require workers in a conference room for everybody to be boosted, would that change how you feel about the mask component, or no?
I do. I think that, especially now looking not just at the Pfizer data, there's 3 other studies. There's 4 studies total. And it's not just the Omicron variant, Andrew. It's also that real world data prior to Omicron that we saw with the effectiveness of that third dose in all of the settings involved, older, young, et cetera. I do think that it makes a pretty critical difference. I've been telling people you don't have to wait for the CDC. You can make these decisions on your own. It's interesting, though. There seems to be some resistance to that third dose. People feel like it's quote unquote not essential, including employers. But again, looking to the CDC, hopefully to have enough data to change that definition, possibly as early as January or February.
So that's what I was going to ask you. By the time the CDC changes, if they will change it, I think it's almost inevitable that they will change it.
Right.
The question is when, and are they doing it too late?
Yeah, that's usually what we see with the CDC is that we do feel like it's too late, which is why I've been trying to, many of us in public health have been trying to encourage people to take these actions voluntarily. You are seeing some cities, New York City and others, who are putting out this guidance that, you should include boosters in what we would consider full immunization for especially high-risk settings, including healthcare settings. However, nobody has gone that extra step of requiring it. I think that will change. And especially for nursing homes, this seems like a no-brainer, Andrew, given the infections we see in some of the congregate settings we've talked about here, including schools. This feels like it will happen before the CDC takes action. But interestingly enough, that 16 to 17-year-old booster recommendation, that wasn't something that any of us expected. And I think that indicates some of the sense of urgency to make sure that people understand boosters are necessary. In the 16 to 17-year-old range, remember, they're still optional. The CDC used the word may versus should for 18 and above, but I suspect that'll change as well.
Yeah, Dr. Patel, that was going to be my point. They have been kind of behind the eight ball and behind the curve on some of this stuff. But it does seem like the measure yesterday with 16 and 17-year-olds, it's kind of stepping up in that urgency, because not only did the FDA pass it, surprising people, the CDC passed it a few hours later without checking with the advisory board. Same thing with just kind of earlier this week with the immunotherapy being allowed for patients as a preventative measure if you're immunocompromised, for those monoclonal antibodies. It just seems like there is some urgency that's picking up, and maybe they've heard the complaints and are following through.
Yeah, and I think the FDA and CDC has made it clear that they'll do everything to kind of fast track, so to speak, any Omicron-specific vaccine development. They're also we're all waiting with bated breath on the Pfizer antiviral oral pill, because that just seems to hold such strong promise for both vaccinated and possibly unvaccinated and possibly vaccinated individuals. So we're hearing about so many things that the agencies are trying to do, and they are. I think that it's just always, when we see news developing, we want things to happen quickly, and they have a process that they follow, not necessarily at the speed we would like, but they're committing to doing it as quickly as possible. I hope we see some of those developments in January as well, the oral antivirals. And as you mentioned, Becky, that pre-exposure prophylaxis monoclonal antibody, a one injection intramuscular AstraZeneca product, has pretty incredible data, but limited to immunocompromised, severely immunocompromised people, about 2 to 3% of the population. But that could be a game changer for patients who don't mount any response, organ transplant, people in CAR T cell therapy, people on chronic steroids or TNF inhibitors, some of those drugs for rheumatoid arthritis and lupus and MS and cancer. Big game changers just in time for the holidays, hopefully.
And then, Doctor, finally, I want to just ask you practically yourself, given this new variant and its entry into the United States, have you changed? I know you're boosted, I'm boosted, and I keep thinking to myself, I've been trying, I've sort of returned to my life in a way, in a great way, actually. But I now wonder, is that, am I doing it right? Am I making a mistake?
No, you're not, Andrew. And if it makes anybody, I'm very transparent about my own behavior. Taking the first vacation with my vaccinated children over the holidays, feel very comfortable. Air travel, domestic or otherwise, I'm domestic. But I think that we have to have faith in the vaccines. That data that Pfizer recently released around its activity against Omicron for people with a booster is sufficient for me to feel comfortable. I'm going to wear a high quality mask. I'm going to make sure I'm not in a crazy environment with people who are actively coughing and not wearing masks around me. But I think I can make those decisions and safely have holiday plans, back to office plans, holiday parties, even gatherings, and do it safely. And I'm going to be using, as we've talked about, testing where possible if I decide to go into an environment. Haven't done anything risky yet where I've implemented rapid or PCR testing or quarantine myself, but travel will be my first test.
Okay. Dr. Kavita Patel, thank you as always for joining us. Have a great weekend.
You too.
Coming up, we're going to talk Omicron and global fuel demand, and an outlook from Goldman Sachs head of commodity research, Jeff Curry, when he joins us after the break. And check out the shares of Moderna falling after it reported some interim early stage data for its mRNA flu vaccine. The numbers did show that the vaccine successfully boosted titers against all flu strains 29 days after vaccination, but stock is down. The company said the phase 2 study is fully enrolled and preparation for a phase 3 study is underway. We're hoping to learn more from the company about, whether there is something that wasn't quite as good as had been hoped, because stock's down, but could be down. Who knows? Conference call at 8 a.m. Squawk Box coming right back. Currently, oil, checking on that. WTI up 81 cents, 1% at 71 and change, continuing to bounce from the late November lows and up marginally. Joining us now for more is Jeff Curry, Global Head of Commodities Research at Goldman Sachs. You're looking beyond, Jeff, I think, the Omicron demand worries into what, in your view, is more lasting and probably more permanent, and that's supply. And sometimes, when demand concerns hit the markets, that just exacerbates the supply concerns, because then, resources don't go towards increasing the supply.
Absolutely. You see it not only in oil, but pretty much across the commodity complex. Given a combination of poor returns over the course of the last several years, plus ESG, investors were wary of oil and commodities to begin with. Then you add this volatility, and we saw this type of volatility around the Delta variant back in July, and then once again right around Thanksgiving with the Omicron variant. A lot of investors said we've had enough with this space at a time that it needs capital more than ever. And so what we're seeing is a lack of capital to be able to grow the supply base, particularly when we look out into next year, when it's all likelihood OPEC's spare capacity will be exhausted. The likelihood of an Iranian deal is declining, and we have yet to see any significant shale drilling. So this market starts to look pretty tight into 2022, which creates a lot more upside risk, particularly given where the forward prices and even the spot prices are today.
And you look at how the odds are stacked is what I'm trying to get to. You look at how the odds are stacked with Omicron, and we're hoping for the best, that they're mild cases. Then we've also got these therapeutics that we were just talking about. You may get a fourth shot. The Omicron might not be like Delta in terms of just spreading everywhere. So that could go away, and you're still left with this supply issue. And you've got those therapeutics that are coming in maybe 3 months, 6 months. So it just seems like this is really temporary, any demand concern. So are you looking for sharply higher commodity prices, oil as well?
Well, I mean, the one factor here, the big story in oil was the vol market. You look at positioning in flat price that's directional. It had already come off tremendously. Where all the positioning was in the vol positions. You also saw that in the equity market. And when Omicron hit and brought oil prices down, at least on the forward basis in calendar 22, down to around $65 a barrel, you started to get into that strike zone. The dealers had to sell and sell and sell to cover their positions, which is why it was so violent to the upside. That's what we call a negative gamma effect. And that brought you all the way down. And then immediately, as soon as things started to stabilize, and as you pointed out, people realized, Omicron is not nearly as bad as we thought. You started moving back up to those strikes, and that buying, whipsawed you back up to 75. We still have more upside risk associated with this negative gamma effect. But I think one thing that's apparent going into year end, just given the volatility, is that risk is going to be slow to come back into this space. We don't think until after the first of the year that you start to get a lot of risk ready to put positions on. They get a clean slate after January 1st. At that point is when we think you get the real upside back towards $90 a barrel.
So could you see I'm not talking about speculators or the people that provide the liquidity for this, but what about spot? Couldn't you see spot, just that even if risk doesn't want to return because of that group, couldn't you just see demand outstripping supply when this reopens full force? And it won't matter whether people trust it and want to speculate. It's going to go up based on people just using it.
That is a great point. That makes commodities and physical assets radically different than financial assets. Financial assets don't have any forcing mechanism to get people to buy it. Take energy shares. That's why they sit there and they languish at the low levels. In contrast, oil and commodities have a captive consumer and a captive producer who can do nothing about their position. And you're absolutely right. As we go into the holiday time period, that's when we would expect the physical demand to push us much higher. That said, and we think you're absolutely right, and that's going to be the key driver as we go in towards the Christmas holidays. But to get, to create that follow through, the overall liquidity from speculative positions does help. And they were extremely light as of last week, because we just saw the liquidations that in one week was somewhere around 110 million barrels, which that's a lot of oil being liquidated by the spec community. You get that back into this market combined with a tight physical backdrop, as you're referring to, that's what creates the real upside going into year end.
Can you just broaden it to metals and we have these inflation numbers coming out. What about just commodities in general? What are you expecting?
It is pretty much the same story across the commodity complex. I like to point out the underinvestment story, predates COVID. And in fact, the seeds of it were sowed all the way back to 08, 09. We call it the revenge of the old economy. Put bluntly, poor returns in this sector going back across the old economy for nearly a decade saw capital redirected into the new economy, which is where we grew a lot of supply. We choked off that supply base. COVID surge in demand, ultimately exposed it. Inventories across the board. In fact, every single market, with the exception of corn, is now in a deficit. I've never seen that type of market where everything is in a deficit. Inventories and metals are approaching critical operating levels. We think in copper, you'll be there by January, which then exposes you significantly to the upside, again, going into those holiday months before you get into the Chinese New Year. So it doesn't matter if it's metals, oil, even agriculture, these markets are very tight, inventories are low, supplies are being constrained, demand is relatively strong, creates a lot of upside risk. Now, our target on copper next year is 11,500, is trading around 9,500 right now. So, equivalently big upside in metals.
That's deep, Jeff. All these input prices, and then you got labor and wage pressures. This is like, I don't know. It's been a long time, but we'll see how it plays out. Jeff Curry, thank you.
Great.
It was great.
Thanks for having me.
I have to think about everything you said. That's typical.
Coming up in just a moment, Senator Bill Cassidy is going to join us to discuss vaccine mandates and so much more. And then later, investors are going to want to pay attention to this because the CPI data due out this morning at 8:30. The futures ahead of those numbers, they're higher. The numbers, an instant market reaction. It's all coming up as Squawk Box rolls on. Good morning. We are now just 30 minutes away from what's become the hottest economic number for investors. That is inflation. November CPI expected to hit its highest level in nearly 40 years. We're all over this story, and we're going to bring you instant reaction. And we're going to talk about what the number could mean for the Fed's taper strategy and for the trajectory of the biggest tech stocks in the world. Hedge fund manager Dan Niles will join us. Futures are calm, the S&P tracking for its best week since February. So much to get to in the next 60 minutes. The final hour of Squawk Box begins right now.
Good morning and welcome to Squawk Box here on CNBC, live from the NASDAQ market site in Times Square. I'm Joe Kernan along with Becky Quick and Andrew Ross Sorkin. The Money Wheel, we used to do the same stories over and over again every hour. I mean, but we're not going to. But you're in red, I'm in red. Andrew, this was, I didn't see it. I wasn't up, but are you serious? That was something. Number one, Purdue. You don't see buzzer beaters like that often from half court. From half court.
No.
From half court.
From a team that has not been good. We had a 4-4 start going into that game last night and took out the number one team. Granted, Purdue was only number one for a week, but man, this turned.
I've been betting on Purdue, and they've been covering a lot of their. And I would have last night, but we're not allowed to bet on Seton Hall in New Jersey or on Rutgers or anything like that. So I saved the money, and so I can enjoy this with you and not be. And your husband, was he crying? Did you see him? He told me he was crying like
he did.
Tears.
He wasn't joking. I mean, he
tears
teared
rolling.
up. He was like, not rolling, but welling eyes. Yeah,
such a softie. That happens.
This has never happened for Rutgers before. Never beat a number one team. So.
I'm so nervous when we don't talk.
And we were just watching it for fun. Didn't think it was going to take off, but the game kept getting better and better.
Can't use this to invest, Becky. We got to move on. Yeah, U.S. equity futures. U.S. equity futures. This is you. This is not me. This is all your fault.
That was all you.
Yeah, Dow Jones is up 36 points early on. The NASDAQ is 9 and change. The S&P up 8. People are talking about this everywhere. My wife just said it last night at her gallery. She had a little thing in there. Everybody was talking about it. So a lot of people were talking about the Rutgers shot. It's crazy. And Ron Harper Jr., the legend's son. Treasury yields, as you can see right now, are indicated a little bit, or are not indicated like the averages. These are actually, that's where they are, 1.51% on the 10-year. And in addition to that big game, Becky, here are some of the other. You go.
Okay, let me tell you about some of the other headlines that people are going to be talking about today. First up, workers at a Starbucks cafe in Buffalo, New York, voting to unionize. Despite its small scale, this was a closely watched race in the organized labor community because it could encourage other restaurant workers to take action. It will be Starbucks' first union location out of roughly 8,000 company-owned stores in the United States. Workers at a second Buffalo cafe voted not to join the union, and results from a third store aren't yet clear. The stock barely budging on this. It's up by about a penny. In Washington, the Senate clearing a key hurdle on the path to raising the federal debt ceiling. The chamber passed a bill that would allow it to increase the government's borrowing limit with a simple majority vote. That's expected to take place next week. And check out shares of Oracle soaring after the company posted fiscal second quarter earnings and revenue above expectations. Right now, the stock is up by about 12.3%. In the conference call, company co-founder Larry Ellison also took a pretty thinly veiled shot at its cloud competitor Amazon, citing one of Oracle's customers who said its cloud never, ever goes down. Earlier this week, Amazon Web Services suffered a major outage that hit sites across the internet. Andrew?
Thanks. Meantime, I want to get straight over to Dom Chu, who joins us now. We're about 90 minutes before the opening bell on Wall Street. Take a look at some of the pre-market movers. Dom.
All right. So if you take a look at, first of all, what's happening with shares of Moderna right now, this has become very much a momentum story. To the upside earlier over the past 12 months and then to the downside right now. You can see those shares from Moderna down about 8% in the pre-market trade, now down 10% near the lows of the pre-market so far. If you take a look at the trade, it's been pretty dramatic to the downside here. This is after Moderna actually comes out with some generally more positive results from one of its more early stage flu vaccines. Some questions from investors with regard to the comparability against some of the other vaccines that are already on the market, some competitors out there, perhaps Novavax, others as well. So Moderna is down about 10% right now, and you can see there a big move over the course of the last week. With the moves in the pre-market, if they hold in the opening bell, it could be a 50% plus drop from the highs, the record highs that we saw just earlier over the course of the past year. Also watching what's happening other parts of the market as well, namely with regard to Southwest Airlines, helped lower today to the tune of 4% after a down day yesterday. Analysts continue to kind of downgrade or re-rate their stock. This morning, it's Goldman Sachs analysts who've now cut this particular move to a sell rating and a $36 price target. They think that the inflationary pressures around Southwest Airlines cost structure could be a bit more of a headwind as well. They join analysts at Jefferies, UBS, others over the course of the past couple of days that have taken their rating down on Southwest. So keep an eye on those particular shares. And then Apple, we're talking about them again because Morgan Stanley's Katie Huberty has written another note. This is by my measure, I think the third note that she's written this week with regard to Apple. Again, talking a little bit more about the augmented reality, virtual reality ambitions that this company could have and why investors today should start to price that into the stock. Apple shares, by the way, $174.70, just about flat on the session, but everybody's watching that $183-ish mark for that $3 trillion market valuation. And then, Joe, as we do often in this hour, a look at the top most popular tickers, search on our website, CNBC.com, over the last day, yesterday at least. Lucid was near the top of that list, up about 0.5%. Tesla down 1%. GameStop, Costco, Lululemon, big move on the heels of earnings after the bell yesterday. So those names among the top 10. The rest of them are on my my Twitter feed, rather, at The Domino. You can check those out there. And by the way, Joe, I'm living vicariously through you and all those other Jersey basketball fans with Rutgers and everything else. And by the way, no one's really talking about the fact that Seton Hall had a great win against Texas last night as well. So Texas, I didn't
even see that. I can't bet on those things, but I knew that they were playing Texas. Yeah, Seton Hall and Rutgers are both. They could beat any. Well, obviously, anybody can beat anyone on any given night. That's why it's so cool. I don't know. Rutgers football got a ways to go, I think, but on any given night, number one Purdue done.
Yeah.
You don't see half shot. You don't see buzzer beaters from half.
No. And I would also say this. I mean, and this is nothing to take away from Rutgers. That was an amazing, amazing game. But Seton Hall is actually a top 25 team right now. I mean, Seton Hall is actually a top 25 team right now, right? And they were actually favored against, I think it was number 6. Texas was ranked like 6 or 7 in the country when they beat them last night. So they were favorites at home against there. So, good for New Jersey basketball.
Eric told me we got to move on, which makes me want to continue. Just does.
I'm going to stop talking now because I'll get grief if I keep going.
I mean, when I hear about it, just really, I think that maybe that's what's wrong with mandates. I don't know. But if you tell me something, I feel like not doing it. Anyway, a bill that would overturn President Biden's vaccine mandate on private businesses is awaiting a potential vote in the House after the Senate passed it, 52-48, though it's far from clear that the House is even going to take it up or approve the measure, and then the president would veto it probably. The administration has aimed to have all private companies with 100 or more workers mandate vaccines or institute regular coronavirus testing. Joining us now is Senator Bill Cassidy, a resolution co-sponsor. He's also a retired medical doctor. And good morning, doctor. And I'll tell you what occurs to me about this whole debate and why it's so difficult and why both sides feel so strongly. Once we figured out that not all people respond to the vaccines, immunocompromised people, you can't vaccinate them into health. Because their immune systems can't do it. So until we get a therapeutic, it doesn't matter. You can't say, I've got the vaccine, it's my business. What they do is their business. You can't say that anymore because people that aren't vaccinated, it could make its way to someone who did what they were supposed to do, were properly vaccinated, and they still get it. So it really is incumbent upon everyone to do this for those people that can't respond to it. Someone could die based on not being able to respond to the vaccine, right? So we need to get everyone done. We've done it before. Why not do it now? Mandate. So private company.
I'm a big believer in vaccination. I've heartily recommended vaccination from the get-go. But there's always a tension between personal liberty and public health. to what degree does the federal government institute a measure that takes away personal liberty? Now, state governments do it, local governments, school boards, we have a long history of that. The federal government, this would be brand new. Not because it's been discussed in Congress or has some kind of national discussion about it, but because the president does it by executive order, reaching into private businesses. And by the way, kind of not cognizant of the impact. One example, I had an ambulance company call me. The ambulance company is publicly traded, does Medicare and Medicaid. He's competing, if you will, for employees against a municipal ambulance service. The municipal ambulance service is not under the mandate. So his employee can quit and go work for the municipal. The municipal does not bill Medicaid and Medicare, so therefore the president's mandate does not cover it. This is the sort of thing that you got to think about, and this executive order does not think about.
Until we get therapeutics, how would you try to help people that are called pandemic prisoners? What I think something that also threw us for a loop, Doctor, was that fully vaccinated people can still kind of be carriers, even if you've had a booster, and therefore, whenever you get to the weakest link, someone's life is at risk. So it seems like we're not where we hoped we would be by this time because we don't have the therapeutics.
So, Joe, you just point out kind of the flaw in your initial argument. The vaccine does not necessarily prevent any infection whatsoever. It keeps you from serious illness. It keeps you from hospitalization. That is a good thing. But the idea that if we vaccinate everybody, there will be no infection, so therefore we all are kind of hunky-dory, is not true. Now, by the way, one thing that's also not been kind of emphasized enough, at least by CDC or acknowledged, is that people being infected previously gives a level of immunity. So there's different things that give immunity. There's different risks, even if you have some basis of immunity. But going back to my point, there's always a tension between personal liberty and public health. The president's vaccine mandate pushes the federal government in an area where it's never been done before, mandating on a federal level a vaccine, and without any other discussion except the president with his advisors. I actually think it should be more fulsome than that.
Senator, two questions. One is, while I recognize that clearly the vaccine unto itself may allow for breakthrough infections, clearly the science suggests that statistically your chances of getting infected are so materially lower than if you're unvaccinated. It's not even a close contest. So yes, breakthroughs are possible, but if you're trying to reduce the possibility, you do it by a material amount. In fact, something on the order of 90% for those who are boosted. So I think that's an important point in the sort of context of all this. The second thing, though, when it comes to personal liberty is, who said that you have the liberty to give me COVID?
You make a really good point, but may I point this out? We would save a lot of lives if everybody drove 35 miles an hour. If the federal government had a mandate, you're going to drive 35 miles an hour, and if you go above it, you're totally busted. In fact, we're going to put a governor on your car so that you cannot exceed 35 miles an hour. We would save a lot of lives.
Senator, we do have speed limits. We've got 55-mile-an-hour speed limits, 65-mile-an-hour speed limits, 35-mile-an-hour. I don't understand that line of questioning because we do have exactly what you just laid out.
No, I'm not saying have no speed limit. But when we had 55-mile-an-hour speed limits and people actually obeyed, people at some point stopped obeying, and they did 75. Now they do 80. So you're going to have more accidents with more personal liberty.
But
I'm not saying no speed limit. And when it comes to immunization, we have private businesses that are putting out mandates for the hospital employees to be vaccinated, for the school employees to be vaccinated. We've always done that on a local and a state level. On a business level, we've never had the federal government reach in to the private business and dictate that kind of, okay, in the tilt between personal liberty and public health, the federal government weighs in. That's my concern.
It's weird, Senator, that both sides use my body, my choice when they want to use it. Neither side listens to the other side when they use the same argument. Have you ever thought about that? It's weird.
I'm not actually going to accept that. By the way, again, I'm a big believer in immunization. I ran hepatitis B vaccine programs and flu vaccine programs in my practice. But I always had to respect the autonomy of the individual.
Yeah.
If the individual did not want to be vaccinated, I could not vaccinate her. That's actually the ethic that I kind of embrace. She is ultimately the decision maker as to whether she or her child or he gets vaccinated. And I think we have to be very careful before we step into that space. That is a kind of maxim of government. I mean, of public of medicine.
It's really staggering how strongly both sides feel about the issue, Doctor. Like so many things, and it's so hard to find middle ground. Anyway, we appreciate your time this morning, and it obviously helps that you're retired. I don't know. You used to be helping people, healing people, and then you go do this. Are you sure that was the right move?
You know, it's addressing healthcare by other means, and so
Okay.
one's a meta and one's a micro.
You're right. Thank you for doing it. We appreciate it. Thanks.
Thank you.
When we come back, the number of the morning, November CPI. Plus, what will the Omicron COVID variant mean for the return to work and the commercial viability of this country's biggest business districts? We're going to speak with the CEO of New York-based mega developer-related companies. Stay tuned. You're watching Squawk Box, and this is CNBC.
Coming up, we're going to talk mega caps and a nearly $3 trillion market value for Apple with star tech investor Dan Niles. Don't go anywhere. Squawk Box coming right back with that and the big inflation number. Welcome back to Squawk Box. The Omicron variant has now added a new question mark to employer plans to bring workers back to the office. Last month, even before the new strain emerged, a survey of big New York City businesses found that less than 30% of Manhattan office workers were back at their desks, and fewer than half were expected to return by January. Joining us to talk about what this all means for high traffic commercial areas in New York and beyond, Jeff Blau is the CEO of Related Companies, one of New York's biggest landlords, and Miguel Prado is the CEO of Energy Re. He's going to join us in just a moment. He's here to talk about a new sustainability project in the city. We're going to get to that in a moment. But first, I want to ask Jeff about what we're seeing in the office space occupancy component of all of this. Is it getting better, Jeff?
Good morning, Andrew. It absolutely is getting better. I know as you walk through the city and go up and down the streets and try to get places, traffic is as bad as it's ever been here in New York, which in a strange way is a great sign. Our office occupancy, you mentioned about 30, we've actually been closer to 45%. I think companies are getting back to work, and I think that's a positive move. What we're hearing from our tenants is January is going to be the big day. Everybody is encouraging their employees back. I think companies have finally realized that innovation, productivity, brainstorming, and all that really has to happen in person in the office. And I think we'll see right after the New Year's a big push back to the office.
Jeff, how are people thinking, though, about this variant? We had Dr. Patel on earlier. She was saying in certain circumstances, she thinks that some businesses should revert to having masks in the office for large sort of congregate settings. And then there's a separate conversation about whether to require boosters or not. What are you doing, and what are you hearing from your clients?
So here at Related, we've had mandatory mandates for several months now, and we are not masked in the office. And I think if you look at cities across the country that have taken the approach of going with vax mandates as opposed to going back to masks, I think that has been a much more successful recipe. California, as you probably know, is still mandatory masks everywhere. And if you look at the percentage of people back in the office, back in restaurants, back in gyms, it is nowhere close to New York. And so I think the right way to do this is get everybody vaccinated and get back to the office. And that's what we're seeing here.
Real quick, and then I want to get to this new sustainability project, this joint venture you're working on. But what are you seeing in Europe right now? And are there lessons there that may be applied here?
I just got back from London, and even London is much more open than even New York. I mean, there's really, they too, I think, are really relying on vax mandate. You don't really see much masking happening there at all. And, both London and New York, to me, feel very vibrant. I mean, in terms of going out, restaurants and traffic and activity and Christmas parties are all back. And I think that's, really a very positive sign for these cities and the economic recovery that I expect will happen in 22.
Hey, Jeff, we're going to bring Miguel in here, but help set this up in terms of what this new joint venture and initiative really is.
Right. So as you know, Andrew, we've always, we own our buildings long-term and have really focused on sustainability for years. And what's interesting is New York City passed a law that was meant to limit carbon emissions from our buildings that we ultimately realized no building owner could really comply with because of the grid here in New York State and New York City, which is really driven by fossil fuels. And we realized that the only way to clean that up was to build renewables here upstate New York and bring that renewable energy into New York City. And we did that. We proposed a project to New York State, and last month we won what will be the largest renewable energy project ever built in the United States, an $11 billion project. We're partners with a company called Invenergy based in Chicago, and the project is called Clean Path. And it will ultimately deliver 16% of the energy to New York City, all renewable, all New York, wind and solar powered here in New York State. And based upon that, go ahead.
No, I was going to jump in and try to just bring Miguel in to explain how he's going to do that.
Right. So I was going to say, based on the success of that, we really, and speaking to our government partners across the country, we realized that this problem of urban load centers and dirty grids is something that is consistent throughout the country. And we realized we had a business opportunity to help clean that up. And we reached out, we did a search, and we hired who I think is the absolute best in the renewable energy space, Miguel Prado, who is formerly the CEO of EDPR, and he can tell you how we're going to do that.
So, Miguel, how does this work, and how do you do wind energy and solar, especially for a place like New York City, where I imagine a lot of that's going to have to take place outside of the city?
Yeah, thank you for having me. I mean, it's a pleasure to be here with you. And Energy RE mission is to provide renewable energy solutions to the American households and business, with a special focus, as Jeff was saying, on the urban centers and other communities that don't have access to renewable energy. Energy RE, I mean, will focus especially on building transmission and generation to provide energy to cities as New York. At the end, what we are doing is very simple. We are connecting generation with the load centers, which is what CleanPath New York is doing. I mean, the US configuration of the electricity grid was based on existing generation models based on centralized fossil fuel plants with a lot of capacity. But now that we are moving, and is the objective of Biden administration to move to renewables, the new renewable electricity generation model is more dispersed and dictated by the wind and energy resource. So this will require connecting generation with the cities. And in order to do that, what we need is to build a lot of transmission.
And how much energy is lost along the line of transmission? Meaning, how important is the distance component of all this?
Yeah, I mean, the distance is important, but at the same time is how we configure the transmission lines. I mean, in this case, for example, in the case of CleanPath, what we are going to use is high voltage DC, which is much more efficient and reduces significantly the amount of losses. And then we will use converter substations in order to transform that DC energy into alternate current, which is what it will go into the cities. So effectively, I mean, we'll have solutions in order to reduce those losses. Although, as always, I mean, the closer we can be to the cities, the better. But it's very difficult, I mean, to build solar or wind farm close to a city.
It's an interesting and important project, and I know we're going to be watching your progress throughout. Jeff and Miguel, want to thank you this morning.
Thank you, Andrew.
Thank you so much.
Thanks, guys. Joe, inflation.
Andrew, look what time
number.
it is. Yeah, look what time it is.
Yep, we're here.
We got 30 seconds. We're just 30 seconds away from brand new CPI inflation data. What we know of it will be brand new, but it's been happening. So it's actually not brand new. It's been happening for the last month. Rick Santelli and Steve Leisman, there they are, the dynamic duo. Who's Beavis? One of you guys want to volunteer for Beavis? You know what the other guy has to be. Oh! Anyway, let's. The numbers is coming in. If you guys can argue about that. I'm sure viewers can't decide. What is the number?
All right, it's now 8:30 on the dot. We're awaiting these numbers. Of course, it's the November read on Consumer Price Index, up 0.8 on headline. That, in a way, is good news because that 0.9 in the rearview mirror was the highest level since 2008. Let's call it 13 years. If you strip out the all-important food and energy, it's up 0.5%, up 4.5, and that is moderating from some of the recent higher levels, and that is a good thing. But here's the Moneyball numbers year over year. Year over year, up 6.8, and this, of course, is a new record. That is the highest level since June of 1982. And if we look at food and energy year over year, it's up 4.9. And that also is a high water mark. That is the highest level since June of 1991. We'll call it 30 years. These numbers were expected. As a matter of fact, on the year-over-year numbers, the analysts and sources I talked to nailed it. They had the predictions right on. And if you look at what's going on with the interest rate complex, it really isn't moving all that much on any of them. We were testing the 70 over 70 level in twos. It's right there. It dipped a bit. Now it's right there. We're hovering right around and below 150. and many are probably scratching their heads why. I think much of this was built in. I still think that there are many that believe some of these issues will moderate. But as your last guest, the topic was energy. I will continue to hang my hat on some of these longer-term predictions that lack of investment in the energy complex due to policy mistakes and the handoff from fossil to renewable is going to definitely continue to put upward pressure on these. Many think we're going to see 125 to 150 in the years ahead on crude oil, and I'm not sure that I can disagree with that. Joe, back to you.
Just had Jeff Curry from Goldman on. He said not just oil underinvestment, Rick, across the entire commodities complex.
All fossil fuels.
Not just fossil fuels.
And commodities.
Copper,
rare earth commodities in general. Yes. Yeah. Well, that's a great thing, right? Because as we get ready to have everybody switch over to batteries, if it was like I Dream of Jeannie, you wiggle your nose, you do your arm thing, and everybody now has battery cars. Where are we going to get all the nickel? Where are we going to get the lithium? Where are we going to get all the rare minerals and earths? What, from China? Because I know that the places they're located in the U.S., nobody's going to let you put a shovel there. The whole thing just almost defies logic. Our hearts are in the right place. We're thinking correctly, but how we move along and implement is completely fraught with errors.
Rick, I think I Dream of Jeannie blinked. I think it was Samantha that did the nose. So just to get things exactly right, right? Bewitched. Anyway, yeah. Steve, you got any comments?
On this energy thing, I think that it's a little premature to say. I think what you're talking about is something that's going to affect oil and gas down the road. I think right now you still have an industry struggling to get back. When I look at rig counts, they seem to be on the rise. So, and also the idea that OPEC is still coming in below where it was pre-pandemic is not an issue of U.S. investment. We've come back up about 800,000 barrels, I think, from the low. I look at the rig count, it's going up every week. So I think you're right. Over time, there's going to be an issue with this poorly executed handoff. I don't think that's what's going on right now with energy prices. It's just my take on that. But let me just give you analysis on the CPI, which is a really technical analysis, which is that everything's up a lot. I think that's just the way to say it. I got food up, I got food at home, food away from home. The biggest increases are, as you guys were talking about, they were energy, 3.5%. And now one of the new things that's happening here is that shelter is up 0.4 on the month, 3.4% year over year. That's been on the rise. But when I look at the market, well, the fixed income complex, it looks like the 2-year is actually off now. It had sort of positioned itself for an even hotter number, up 72 basis points. Now it's down, now it's at 68 basis points, or 69, call it. I see the 10-year selling off. The market was well positioned for this, and the impression I get, at least the very initial impression from the market's reaction to this number, is it feels like the Fed is positioned for this. Remember what we're going to get. We're going to get a faster taper, probably double next week, and then an outlook for rate hikes that's going to put 2 or 3 rate hikes into 2022. The market is not screaming for more, and the market does not, at the moment, seem upset by what it's about to get. So what you have is you have this adjustment period before the number, and so far at the moment, and I even see, by the way, the stock futures rising. At the moment, it seems like everybody's kind of copacetic with where we're at, even though these numbers are hot across the board, and I think there's more to come.
Right, with where we are, I think is sufficient. Mike Santoli, let me get you in here, because I mean, you look at. I'm not saying the Starbucks thing is going to be just the end all be all for labor rights but we definitely have wage pressure. It seems like we definitely have commodity pressure. These things are not good for stocks. When do we finally decide that multiples need to come down, or that we've already paid it forward to such an extent that there's a pullback? Is it? Don't you think that's inevitable, or I don't know, maybe not?
I mean, multiples have been coming down. Profit margins have actually been probably a little more resilient than you might have expected, given what's going on the wage cost side. Also, I think we're still in this window of time before anybody is going to assertively say this is the new trend, or the new trend is decisively worse on the inflation front than we thought, simply because we're still going up against, on an annual basis, very weak numbers from late, last year into early part of this year. It's not really until March that you're going up against the hot inflation numbers. So I think everybody can kind of reserve final judgment on that. Also, at least in a grinding way, the multiples of the market have been coming down. Not too much, but earnings growth has been too strong. In terms of when it becomes a more critical issue, obviously, if all of those core elements of inflation, the drivers like rent, like wages, although wages aren't really measured, right? This is consumer prices. But as they get embedded into consumer prices, if we don't have the really strong nominal GDP growth to go along with it, that's when you might have to have a little bit, it's more of a zero-sum game than it is. All the numbers are going up, including wages, and the labor tightness is what it is. It's not just like a vote in a Starbucks store upstate is going to change the story. We can't find workers.
Yeah. Well, Mike, we may have retired transitory, but it's still, I think people still believe it. They think that the supply chain loosens up eventually, as maybe Omicron is not that bad, but that means that all this stuff we just talked about with commodities, that's not transitory because there's been underinvestment, Rick. So how is that transitory? Why do we still believe it's transitory?
I think we need to learn some lessons from the auctions as of late. The auctions as of late have shown that investors domestically and globally are now taking a much more wait-and-see approach to getting super involved in the treasury complex and what they think of rates. You know what? If I was a trader and every time I sold it, I ended up seeing it back under 150 as a 10-year, back under 2% as a 30-year, but I thought inflation was going to be hotter. What's going to happen is when it goes, it's going to go big in terms of interest rates. We shouldn't lull ourselves into this confidence that, wow, we must obviously think that inflation will come down because rates are down. We have central banks that think they're the Incredible Hulk in manipulating rates. We need to be careful because when they turn, they're going to turn wild to the upside.
I heard someone else wanted to get in.
Yeah, real quick, Joe. I was just going to say you are 100% historically right. I was looking at this. I don't have the chart ready for this conversation. Maybe next week. But when inflation increases, profit margins fall. Except for right now, you have rising profit margins, Joe, amid rising inflation. You could be right that it may be to come, but two things. Profit margins are at historical highs. They have room to come down to become more average, which could affect the multiple. But still, even if they come down, companies would be on an economic basis extraordinarily profitable. And the other thing is, so far, companies have managed to figure it out. It may be that those wage gains are yet to come and show up in the bottom line and reduce profitability. But it has been an amazing thing to watch that companies have remained quite so profitable. As their input prices have gone up, it looks like they have essentially raised prices more and kept their profitability and even increased it. Okay, great. Thanks to everyone involved with this. I was looking up for Rick. You think Loyola? So take Loyola tonight, Rick? They're good, right? Isn't that? Because I couldn't take Rutgers.
Well, I'll tell you what, Joe. I say, why not? There's been some wild upsets that people have been crying about. We know what we're talking about. Yes, it's been pretty exciting, hasn't it?
It has. I'm looking at that in Louisville, I'm thinking, for tonight, too. All right. Thanks. Santelli, that's confusing. And Leisman, which is easy. And never mind on that whole Beavis conversation. Let's forget about it. But I am having, Becky, Twitter people thank me for correcting Rick on the Samantha versus I Dream of Jeannie. You remember?
I do.
Yeah.
I do. Yeah, one was the head bop, one was the ding-a-ding-a-ding.
Versus, yeah.
Yeah. When we come back, we're going to get Jim Cramer's first take on the new inflation numbers. Stay tuned. Squawk Box will be back after a quick break. Welcome back to Squawk Box, everybody. Take a look at the futures after that hot inflation read we just got. The number came in at 0.7% CPI on the month over month, but 6.8% increase year over year. And that's the biggest we've seen in about 40 years. Dow futures, though, up by about 165 right now. The S&P futures up by 30, the NASDAQ up by 122. So you did see the markets pick up. In terms of treasuries, if you've been watching the yields there, you'll also see that right now the 10-year is yielding 1.503%. That's almost exactly where things were right when that number hit. 30-year right now, 1.881%, and the 2-year at 0.699. When we come back, hedge fund manager Dan Niles is going to join us to talk about the new inflation data, what it means for investors in terms of the big tech stocks. We're talking the $1 trillion club here: Apple, Microsoft, Amazon, and Alphabet. Stay tuned. Squawk Box will be back right after this.
Welcome back to Squawk Box. Inflation data coming in at the highest level in nearly 40 years, 39 years to be exact. Futures have jumped. Want to get straight down to the New York Stock Exchange. Our good friend Jim Cramer joins us now. Jim, your immediate reaction, and what do you think Jay Powell is thinking?
Well, I don't think anybody thought it would be anything other than much hotter than people expected. This 80, 82. I mean, 82, you go back and it was a period where the Fed was just coming out of a terrible rate cycle. I mean, these comparisons leave me very cold. What really does matter is that we got rid of the word transitory. I mean, I think Jay correctly anticipated this. But if you're on the conference calls, you know that a lot of it is just COVID related. So I think he's going to get it right again. I think a lot of the wise people on Wall Street going to bet against Jay. That's been a horrendous bet ever since he realized in 2018 not to do things lockstep. So Jay wins again.
Jay wins again, and that means and that means it works for Jay. It works for Jay, and it works for the market.
Exactly. And I want your bulletin to reflect that, when your morning bulletin.
Okay. And then my other question is, we've been debating.
Admit that you do it. It's great.
Thank you. Thank you. We've been the deal book you're referring to. But let me ask you this. We've been talking all morning about Starbucks and this vote. How important do you think it is? And how important do you think it is to the company and the stock?
Well, I've reached out to one of the representatives there who is unhappy. And I think that I would like to think that it's not that important. But the one thing you have to recognize is the unions are thinking, if we can get Starbucks, we can get anybody, because Starbucks does offer the best benefits. So from that sense, I think that you can vote with your feet. If you leave Starbucks, it's pretty easy to get a job that's the higher pay. But I think they got to work. They got to work on these work rules, because I think that it is too easy for people to say, you know what, my boss is telling me to work the 5:30 shift. I don't want to do that. I'm going to go to another place unless we unionize. But remember, they only won one, and they're 19 up in Buffalo, and the rest. So they won 1 out of 19. That's not so great. So I'm saying Starbucks is actually net the winner here, which is why the stock is not down. You would think they would get more than 1 out of 19, don't you?
Yeah, no, look, I've been talking all morning how I think we've been talking about this in a breathless way, but I think there's an element of which it's symbolic, and there's something going on in this. The question is there something going on in the country? And I think there is, but maybe it's not even related to this, because this seems to be a particular situation that doesn't seem to be a truly grassroots effort even, but seems to be the union trying to use this to push in elsewhere.
Exactly. I mean, can you imagine? Yum is you could organize Yum so much more easy. McDonald's, Burger King, but they went after the best. If they can win there, they can win anywhere, and they didn't. I mean, it was just a very small fraction. And look, there are issues at Starbucks, but remember, they give you college, they give you mental, which is really pretty incredible. If you have psychological issues, they give you everything. It's like trying to go after Costco. And Costco had an amazing quarter. So, look, I don't think they won. I want to dig deeper into it. But I thought that both Kevin Johnson and Howard Schultz went there. And the result was people like Starbucks. They like to work there. But there are people who just say, you know, I don't like the hours. And there's some really bad hours. There's some bad shifts, meaning hard shifts. Yeah. And you wouldn't want them. I mean, I had a friend who worked in an Albertson Starbucks, and she kept getting stuck at the 5:30 a.m. shift. And she wanted her off the shift. But the store managers are really powerful. Couldn't get off it.
Hey, guys, somebody posited earlier, and I think it's an interesting point, that Starbucks has so many company-owned stores, like 8,000 of them. If you look at McDonald's, I think McDonald's is only 2,700 or so out of 35,000 franchisees. And it's a lot harder to go after the franchisees. If you want to do it, you have to go after somebody who has a lot of company-owned stores, because that's where you can really make some big difference if you're the union.
Correct. Yeah. But look, if I were the union, I'd be saying, you know what? Let's target somebody else. I mean, the fact is, you can get a job anywhere right now in this country. And rather than unionize, just say, okay, look, I'm going to go over to Wendy's across the street, make more money. I mean, it really is. Right now, there's just a moment where the posted price of what you're going to get is different from what you can negotiate. Imagine a worker being able to negotiate. There's negotiation power by people who typically. I mean, Karen Kramer worked at a McDonald's. She still got that burn that you get from the fry thing, you know, and she did whatever she could take. And now it's like, listen, if I'm going to work fries, you know what? I'm going to ask for X. They probably may not get it, but this is a really lousy time to organize.
I want to see what kind of deal they ultimately get, and I want to see what kind of dues they ultimately pay for what they get.
The checkoff. The checkoff is what, I mean, I've been involved with 2 unions. The union's always made out better than the workers. Now, maybe there's some better unions than I belong to. They sold us out twice.
Jim, we're going to see you in just a couple minutes. Congratulations, by the way, on the effort you had yesterday, your first big meeting of the minds with the CNBC Investing Club. And everybody who missed that, if you did, you can find it online, but you can also jump in now and point your phone at the screen to get involved with the CNBC Investing Club. Becky?
Thanks, Andrew. If you are just tuning in this morning, let's give you a recap of the latest inflation data. The November consumer prices coming in hot. We're talking about the highest level in 39 years. It was a gain of 6.7% year over year. And obviously, this renews a question for many investors is how will the Fed react and what will its next moves mean, especially for some of the high-flying tech stocks? Joining us right now to talk about that on the Squawk Newsline is Dan Niles. He is founder and senior portfolio manager at the Satori Fund. And Dan, you've been saying for a while that this is issue number one, how the Fed will react. What do you think after these numbers?
I mean, I think this really removes any ability for the Fed to take this slow, and they're going to have to taper more quickly than people anticipate. And I've been saying for a while that there's going to be multiple rate hikes in this upcoming year, and that's still my belief. Under a normal regime, you know, you'd have, with this kind of unemployment down at 4.2%, which, by the way, is in the bottom 10% of all unemployment numbers. We see jobless claims at levels you haven't seen since 1969, 6.8%. CPI at 39-year high. You go through the Taylor rule, which is what people used to use to figure out where Fed funds rates used to be. you'd be up at about 7% right now already. So you'd be talking about, how many hikes are you planning on doing? So the Fed's really behind the curve right now, and that's going to be bad for multiples if they have to move a lot more quickly than people are anticipating.
What does it mean specifically for some of the biggest tech stocks? Because we've seen that some of them have kind of wavered, and some of the enthusiasm has leaked out as the concern is that the Fed will raise rates. What do you think?
Yeah, the biggest tech stocks, thankfully, a lot of them are very inexpensive relative to the market. When you look at them with their growth rates, they're making lots of money, lots of cash flow. And I'm talking about Google, Facebook, Amazon, which we all own. The problem you run into is the rest of tech, where you've got a lot of companies that don't make any earnings. They have negative cash flow, and the multiples, you can't even talk about a PE multiple, and you're talking about them making profits out a decade from now. So things like electric vehicle companies or biotech companies, you pick your favorite name in that category, those stocks are going to get just absolutely destroyed in an environment where the Fed has to raise rates in a much more aggressive fashion. And you can look back through history. That's what happens all the time. And when inflation's over 3%, the market has below average market multiples. Right now, you're sitting at record high market valuations, even compared to history. So you put all those things together, the big tech stocks are going to struggle. And we believe the S&P is going to be down next year. Let's be clear about that. But the smaller names, the ones that don't make any money, they're the ones that are going to get absolutely killed.
Dan, I think one of my biggest surprises looking through your notes was your favorite position, you think, for 2022 is cash. It's kind of shocking when you think about inflation running like that, because cash is getting worth less every day in a situation like that. Is that just cash because you think the market's going to drop and then you can take advantage of some lower prices?
Exactly. I mean, think about it this way. The market cap of the entire stock market divided by the GDP in the U.S. is sitting at 1.9 times. The peak of the tech bubble, that ratio was at 1.4. The average is 0.8. And in a high inflation environment, usually market multiples are below average. So if you're thinking next year, I firmly believe we see a 20% correction next year, just as these multiples get back into line. And it could be much greater than that, depending on what happens with profit margins at companies. Because, you just talked about the inflation figures. You've got 3 million more job openings almost than you have people unemployed. Average hourly earnings are up 4.8%. So in that environment, you should be expecting, profit margins to be under pressure, multiples to come in. And, with that kind of backdrop, cash is really good because you're going to get a lot of companies get mispriced on the downside, just like right now, they're mispriced on the upside.
That is some concerning looks when you take a look at that. Down 20%, you're saying, for the year. Dan, thank you. On that note, we're going to leave it for the weekend. We've been watching the futures after that hotter than anticipated CPI number. It came in at up 0.7% for the month over month, up 6.8% for year over year. Dow futures right now up by 146 points. The S&P up by 27. The NASDAQ up by 100, continuing the gains we've seen this week. Guys, have a great weekend, and we will all see you right back here on Monday morning. Squawk on the Street's coming up after a quick break.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer, David Faber at the New York Stock Exchange. Important day. November core CPI brings no real surprises. Up 0.5 is in line, down 1/10 from a prior month. Futures actually gained some steam here. Hedges come off. The VIX below 20 as the Fed arguably has the go-ahead for a faster taper next week. Our roadmap begins with that inflation surge. Highest read year on year since 82. Futures moving higher, but what does it mean for the economic recovery and Fed policy?
Plus, SPAC on the street. SEC Chair Gensler says tougher new rules to protect investors will be coming soon.
And EV Watch, Ford stopping the F-150 Lightning reservations due to high demand. And GM's Mary Barra says, quote, "We're first, full stop." First, though, we'll begin with consumer inflation in the supply chain, Jim. Internals, as Leisman said, everything's up. And we talked a lot about used cars and trucks up 31 year on year.
You've got to listen to Rich Galanti, who's an amazing CFO at Costco, to get a read on everything that's up. And he just says basically everything that's up. And there isn't anything that doesn't sell out very quickly when they get it in. One of the things he also says, by the way, is that this shipping thing is a disaster. I mean, almost the numbers he gave are that, get this, they're seeing 79% of containers are late by 51 days. And he calls it, he's got 4.5% to 5% inflation. It's a great call. Now, the best call I've heard about what inflation means was from Doug Yearley, CEO of Toll Brothers, saying that they can't finish the homes. They have to go to Home Depot to buy the appliances to finish. So there you've got think about the embedded inflation. There's nothing transitory when you do have to, when you're one of the largest home builders and you go to Home Depot, you can't go to Whirlpool because they don't have any. So yeah, it's embedded, it's bad. And obviously Jay was right to say, listen, we got to go here.
Yeah, meanwhile, 1982 is the last time we saw this rate of inflation. What were interest rates then?
It's interesting because if you remember, that was when Reagan was trying to get the economy, if you remember.
That was Volcker. I wasn't.
Well, Reagan
actually.
was president.
Yes, I'm aware.
Yes. Well, they worked very closely. Reagan used to talk to Democrats. He used to have beers with Tip O'Neill. Thank you, Chris Matthews, for a great book about that. But look, they're trying to restart the economy. But what's amazing to me about this is, I had Hormel on this. I don't even know if we have a clip, but Hormel, which, by the way, 7 straight quarters of good gains in spam. Yeah. But he listed everything that's up. And the fact is he's still doing well.
I know, but meanwhile, you didn't answer the question. The rates were a lot higher than 1,484.
No,
the last time we saw anything close to this level of year-over-year.
I sold treasuries when I was at Goldman Sachs. They were 14% U.S. treasuries 30-year. And I used to sit there and I used to call them, you don't make any money off selling those. You can't change people on the can't charge more for treasury. But I ruined all my customer base because there's never going to get anything better than a 14% treasury out 30 years and then finally rolling off. But yeah, I mean, the rates are so low, it's kind of crazy.
Yeah. Well, I mean, you're a gardener and you love all things landscaping.
Absolutely.
Do you give Pal credit for sort of aerating the lawn at this point?
Oh, he totally gets credit. By the way, outdoor furniture for summer selling out like mad at Costco. Yeah, I think you got to give him credit. Look, I mean, I think one of the reasons why he's so great is that he really kind of did wait to see how far. Remember, he said, I want the pandemic to play out. Now, we do have some spikes, obviously, but he's a man of his word. He basically said, I got to wait. It looks like it's running to its course, and now it's time to act. Now that everyone's full, did you see unemployment data yesterday? So, yeah, it's time to act. Can he stop? Can he start creating cars that have chip shortages? No, but he can cool down housing, and housing is
those numbers are very notable.
Although
Shelter 3-4.
Yeah,
it's a huge part of this.
Amazing. Now, Yearly did say of the affordable luxury, they will not be deterred by higher rates, but there are people who basically want very much to get out of an apartment. Apartments 97% are full. I mean, the country's operating at full tilt, and full tilt. It's like a steel mill. They can't operate at more than 98%. Do 102, they burn out. We're done. We can't work. This economy can't be hotter. It is the hottest I've ever seen. Much hotter, of course, than 82.
Well, you made the Roaring 20s comment this week.
It is.
It's got huge play.
It is. Did it?
Yes.
Did it really?
Yeah, it was all over the place.
Oh, I love that.
Wait. So is that going to be?
Hey, listen, my daughter listened to my investment call yesterday. It's like, that was big.
She liked that. She liked your investment call?
She liked it, yeah.
That's nice.
She thought I was funny. and there was a shout out to someone from her town when the town did kind of burn down.
Oh, look,
Oregon.
there it is.
Oh
There's
my
you
God,
and your
that's a
investing
good
club.
haircut. Shoot.
Yeah, look at sharp.
Oh,
Look at all those people.
I could take off a couple of.
What were all those people doing, Jim?
There's 50 people from 50 states, David.
Wow.
Listening to the investment club, which is a lot more than you did.
I was working. Okay.
Oh,
I was working.
I think he was on air. You guys were on air yesterday. It was really weird.
We worked a lot, but so did you.
No, but yesterday was insane.
What I love, though, is you gave the club stuff that they're not going to get on television.
Right.
The Disney call, for example.
Yeah, we bought some Disney right in the conference call, and I really think that Disney's right. We also had this interview. I think we have
Look at all those people.
sound on. I think we have a little bit of what Jim Farley said. He made major news on our club call.
Let me hear it. Let me hear
well,
it.
you might
Ford
wanna hear it.
CEO Farley.
Yeah, Jim Farley.
Okay, we're going to give him one
That's
second.
amazing.
They're getting that ready.
Well, that's like there was this guy came up when he wasn't ready yet, and it was like he made this cameo. One of our people. Yeah, it's funny.
You know, on closing bell, Stephanie Link went after your Disney call. It's funny. She didn't. I just thought it was interesting. Anyway. We have the Farley sound, so we could go to that if you'd like.
Yeah, we have Jim Farley. We don't have
correct
the wrong Farley. We have Tom Farley. We got Jim Farley.
We got Jim Farley.
Let's get Farley.
Take a
going
listen.
here.
We're completely oversubscribed with our battery electric vehicles, Lightning especially, the F-150 Lightning, America's best-selling vehicle. Everyone loves the electric version. They haven't even driven it yet. Where do they drive it? 0 to 60 in like a 911. It's just an incredible product. It powers your house for 4 days. We had to stop reservations. We've got so many.
Well, that's important because one of the things that's happened is that the one, when he talks about it, Jonas.
Yes, the analyst at Morgan Stanley.
They're all
seems to be having an existential crisis and wrote some sort of report this thing about a death of an auto analyst, and we're a little concerned about it.
Biff was saying, Hap was saying, look, what's interesting is that we've been comparing the reservations of Rivian and Tesla to Ford reservations. Well, now we know he stopped. We were thinking, I guess that was just kind of a blip. No. And I think he's going to get permission to build all of the plants he needs. By the way, Mountain Pass MP Materials, they have found, they're building a giant factory with GM. Mary Barra should not be discounted in this thing. She is making it so that she's going to have the magnet capacity. And I think that she's going to be a comer. So I love talking about Tesla and Musk who keeps selling stock. That's great. Mary Barra ain't selling stock. She's selling cars. That's a good business.
Yeah. Of course, Toyota, which had hoped to have some normal production as of this month, is having to push that back, at least in Japan, because the supply constraints that we thought might be cleared up by year end are sticky.
Well, that's why you have to do what Farley did. Contracts, long term with global foundries. You have to do these long term contracts. America was way too much interested in just in time. Just in time is not great for a company that's trying to figure out whether to build a giant fab.
Right. And an interesting story in the Journal today. Even though you will not see on the horizon quite as many ships waiting to dock at the LA port, they're just further out there, or they're slowing their passage by double. Basically,
so
taking twice as long to get here because they're just going slower.
Oh, so that whole idea that it's clearing up.
It's not.
Ships are an anchor for shorter amounts of time.
Yes.
But they can't help the line outside the club door, right?
Look, we're in a boom of unprecedented proportions. We got to start saying, you can't, look, when you can't keep spam on the shelves, guys, that may be the definition of it. Boom. You can't keep spam.
I have to have a spam on the shelves.
Spam selling too quickly.
Really?
Yeah. No, I made that up. That's a lie. No, we had it last night.
Pumpkin spice spam?
Pumpkin spice spam. You can't. That thing. That's a collector's item.
Well, Costco did mention the cream cheese shortage on the call.
The schmear.
They've got enough, so we can stop worrying about that at least.
Oh, good. I'm glad. Actually, that was very worrisome.
It's always something. Do you remember the actress who said it's always something?
Yes. The cream cheese issue. My friend Gary Greengrass and Brendan Greengrass said they're going to actually have to make the bagel hole bigger. That's how they're going to deal with it.
Oh, that's good. Like that. I got to tell Glanty that. Glanty tells a joke a day. He used to start in CFO. He's hysterically funny. He always puts a couple of jokes in the call, and the analysts never get them. Never.
Where do we come back this morning? SEC Chair Gensler taking aim at SPACs in an online video that you got to see. Take another look here at the futures. As we said, VIX now about 19.5 and 10-year yields session low despite CPI. We're back in a moment.
Suppose a group of strangers came up to you and said, I have a company. It doesn't do much of anything, but sometime in the next 2 years, we'll merge with another company. I don't know what that company is yet. Would you invest in the stranger's company? What if I told you that if the strangers complete a merger, they get to pocket 20% of your investment? That's essentially what a special purpose acquisition company, a SPAC, does.
That's SEC Chair Gensler taking aim at special purpose acquisition companies in an online video. Interesting new way of communicating. Actually saves some firepower against pipe investors who he argues are getting a leg up on regular, normal, I guess, investors, he says.
And I know we're going to David on this, but this was such a breath of fresh air. I mean, this is Chairman Gensler.
Jim, that does not sound like a man who thinks highly of SPACs. I mean,
he trashed them like you wouldn't believe. He buzz-fed them.
Yeah, BuzzFeed is one.
No, this was a remarkable video. Must be watched.
The question is, I mean, we've had him on. He's been on with us. We keep waiting. We know these things take quite a while, but do you have any expectation that something is coming soon from the staff and that we will actually see additional regulation and then where it may be focused?
I'm betting that he's betting it's a chilling effect situation. That they're responsible people say, I don't want to be on the griddle when the chairman takes aim. Like he says, well, let me give you an example. You don't want to be that example. This was horrifying. I mean, if I were running a SPAC right now, I would just say, oh my, I got to solve this.
There are so many out there, and we'll get to that.
How many have been found?
Well, we'll get to all the numbers.
I mean, not everything's DraftKings.
No, I mean, listen, Gensler, new rules around marketing practices, tougher disclosure requirements, better alignment. Of course, we've talked so often about the alignment of incentives between the SPAC sponsor and the investor. That said, many of these SPACs right now are trading below their $10 issue price. Many are and are an opportunity because you can redeem, remember, at 10 or even sometimes $10.20. There's a bit of a yield available to you. And then every so often you hit the jackpot, a la DWAC, the Trump SPAC, as we call it, that I know a couple of people who owned it. In fact, they agreed to be part of the initial underwriting and got warrants and other things as a result of that to get the deal off the ground. And then it hit, and it was look what happened.
But is that a lottery ticket?
Yes, it's a lottery ticket. But why not own a lottery ticket if you know you're locked in? You know, you buy it at $9.80 and you know you're going to get 10 or 10.20. So that's happening.
But what happens with the BuzzFeed, David, which is down so much? What happens?
You know, I talked for weeks, remember, about redemption rates and how they weren't disclosing them immediately and how important they were. This is another example of a company with BuzzFeed where I think it was 94% of shareholders chose to redeem, get their money back, leaving very, very little in the trust account to go to the company than was originally anticipated to help fund its continued growth. And that has worried people. And so BuzzFeed shares, as you see, have been very poor. Any number of other names.
You could do a lot of, right?
Quite poor. And then we have the winners, you know, the Lucids of the world that are sixfold from what their issue price, or at least have been at some point, and created a massive amount of market value. By the way, we've got another big deal today.
What?
I don't know if you noticed, Getty Images. Now, there's a real company.
That's a real company.
It's a real company.
Recommend it.
It's about a $5 billion deal. It's Neuberger's SPAC. They're talking about an enterprise value there of $4.8 billion. It's about 15 times on an enterprise value to what they anticipate adjusted EBITDA will be for next year. So there you at least, you know, you're not talking about out years, 26, 27, 28, where you've got this huge sudden jump that we often see in these projections to cash flow positive from negative. Here you've got a business, obviously, that already has a significant amount of EBITDA, choosing the SPAC route, though, to go public as opposed to a straight IPO, $150 million pipe there. But guys, this has been one of the phenomena of the year, and it's not stopping. You know, our friend Neil Danix over at, we call it SPACalytics, SPAC Analytics. I mean, he says this thing is just a machine. You've got 23 SPAC IPOs already to December 9th versus 62 for November. So December's running hotter. You've got 591 IPOs so far now coming in 2021. And you know, Jim, to answer your question, 568 are seeking a deal. I mean, again, it goes back to this idea of how do you chase that many opportunities, and what do you do, and what are you willing to offer in order to get your deal done, given you as the sponsor still are in a position, to Mr. Gensler's point, to make money even when the stock falls well below $10. And as we know, even though redemptions can be very high, these deals still get approved and rarely renegotiated.
Remember when Dave Coady started with Vertiv?
Yes, great SPAC.
What they looked
there
for.
Are some,
they had a business they wanted to buy.
There are
the other
deals.
way,
There's
right?
no doubt.
They
There
had
are
a business.
deals
They want to buy the business.
that are good deals and that represent potentially good value over time, that have good management teams. But it requires a lot of focus from the investment community in order to. And so, with so many out there, it's hard, Carl, to know where to.
I hope that Gensler succeeds and people watch the video realize this is it's a racket.
Well, for those who haven't seen it, one more piece from it. It's not too long, but it does raise the question of how his communications are going to evolve further in the future. Here's a little bit more of it.
We need to make sure that investors in SPACs are being protected. Look, you as an investor get to decide about where to put your money, but companies raising money from the public have to provide adequate disclosures. I think we can enhance the disclosures that companies raising money via SPACs make. I've asked staff for recommendations about how we might update our rules so that investors are better informed about the fees, the costs, the conflicts that may exist with these SPACs. We'll also work to hold bad actors accountable and keep a close eye on all the parties in these transactions.
Does it make you feel that SPACs are now a higher priority than crypto, payment for order flow, China, or any of the other boiling pots?
I felt yes. I think that it's this is something that I think that Chairman Gensler has wanted to do. Remember when we said his plate was too full?
Yep. By the way, these are the SPACs that have not yet done a deal. Now we've got the SPACs that have announced a deal. Just to give you a sense, they're trading below, right? And then the SPACs that did a deal, we track them. They're also below. So the only ones trading above are actually the ones that haven't announced a deal.
Well, and Chairman points out that everyone early made money no matter what in these. He's not Sondheim, by the way, when you have that orchestration. That's not the late, great
Who did not even get mentioned on our show?
Yeah, he should have. He's been remembered. The lights were dim this week on Broadway.
It's amazing, man. I got to meet him. You did? Titan. Yes, I did. Pacific Overtures in Boston.
Okay.
Yeah.
It's fabulous.
Yeah, fabulous.
I met him at Merrily one night.
Did you really?
Yeah,
Was he just
David?
I didn't meet him.
You never met him?
Never met Son.
Have you met anybody?
Yeah, a handful of people. And he was up near me in Roxbury, too. He was
You
up
could have
across from our
just.
house, yeah.
You could have just.
I know. I could have stopped by for a drink.
Yeah.
To the ladies who lunch.
Vodka Stinger.
Yeah, exactly.
Kramer's Mad Dash coming up and the opening bell. Take a look at futures getting better after CPI runs a bit hot. Don't go away.
All right, let's get to a mad dash as we count you down to the last trading session of the week, about 7 minutes from now. Broadcom reported after the bell. What do you think?
Yeah, David, you and I know Broadcom. This is an amazing company, big cash generator, but pays a good dividend. Now it's a $10 billion buyback. And Hawk Tan has been on our show. Well, one of the reasons why a lot of tech is flying today is because he basically just said, and he can do this, everything is strong. Hypercomputing is strong. Your telco is strong. Now, telco, remember, big customer is Apple. You can't mention Apple. But this is the most bullish I've ever heard him. He wants to put the $10 billion to work right now, buying stock back. There is just basically what he's saying is the spend for hypercomputing among the giants, the mega giants that we talk about in tech, is unprecedented. And they can't make stuff fast enough.
You know, Jim, this is a company that also, though, has used M&A as an important component of its strategy, pivoting from chips to software with the acquisition, of course, of Computer Associates.
Right.
But buying back $10 billion of stock indicates, in a way, perhaps, that there's not anything he sees near term that he wants to buy.
Not indicates. He point blank says it.
Yeah.
He says, look, there really isn't anything to buy. Now, isn't it interesting that you could have all those SPACs trying to find things to buy, and the number one acquirer in the tech space has nothing to buy? And he's a very shrewd acquirer. So I think we keep hearing people who want to raise money to buy things, but the kings who know how to buy things are staying away. Everything's too high.
Now he likes, right, exactly. He would. I'm sure there are potential things that he doesn't want to pay for, but does that detract from the story? Because they have had a good track record of buying things at the right price and executing potentially, at least, on synergies and everything else.
It doesn't detract because he basically can call his own tune. He basically name his price and make you do long-term contracts. This remarkable call. I've never heard Hawk so ruling about his business. Yeah. And the analysts were surprised. He was kind of just so happy.
A happy hop.
Happy hop.
All right. We got a lot more for you, including an opening bell. And don't forget, you can catch us anytime, anywhere. Listen to and follow the Squawk on the Street Opening Bell podcast.
Oracle's up in the pre-market after posting a quarterly beat driven by cloud. Company announces a $10 billion increase in the buyback. Last night on the earnings call, Larry Ellison took a veiled swipe at AWS. In wake of that recent outage, he said one major customer told him that Oracle's cloud, quote, never, ever goes down. Meanwhile, Deutsche ups to buy this morning, Jim.
This was an amazing call. Before Dave and I went up there, I was trying to figure out whether to talk about Oracle or talk about what we ended up doing at Broadcom. And Larry Ellison is in fine fed on this. He completely trashes SAP. Basically says that they're a donor to his business. Yes, AWS. He talks about how the idea that his cloud doesn't really have any people. It's all digital, so it can't go down. On-prem, very strong. Lists some nameplates. Every big bank, Bank of America, this one they just onboarded. Those who want to see what a competitive CEO is like, David pulls no punches. I mean, at one point he says, "Hey, and Mark Benioff, he just used."
Well, he's not CEO actually.
No, he's chairman.
Yeah.
Saffron's
chief technical officer or something like
whatever.
that.
But
some title.
He's chief evangelist, and I just love him. He didn't like me.
He doesn't like you?
No.
That happens.
I once went to his island and he owns a
Did you? The Lanai Island? Yeah.
It's really good.
Don't forget, he also owns a lot of Tesla. In fact, more Tesla, Mike Santoli reminded me yesterday, than Kathy Wood.
Really?
Yeah.
Well, he's a visionary, he's a genius, he's a competitor, but he doesn't care about anything other than winning. And you got to love that. He's doing it. Yeah, he is. And one of the things, it's also business is very strong. That's how you again, that's a tell. The business is made very, very strong.
Very, very strong, especially on the enterprise side. There's the opening bell and the CNBC real-time exchange of the big board. It's clean energy company Altus Power celebrating a listing via SPAC at the NASDAQ. Event management company CVent also celebrating a listing via SPAC.
Imagine a couple of strangers get together and you write them a check, David. That's how it gets some video starts.
The way he presented that, I think it's clear from Chairman Gensler how he feels, or at least how he feels he must educate people.
He doesn't want what happened in 2000.
But they're not going away. SPACs are not going away. It was a feature of this year. It will continue to be. Will we ever see the level of issuance that we saw this year? It's hard to imagine that we'll see eclipsing what it's going to. We're going to be close to 600 IPOs of SPACs this year. By the way, IPOs in general, it has not been a good year if you bought them after the first trade.
Below the listing price, 90% more than
but a
last
lot of
year.
it is due in part to SPACs. Also, many of them trading below.
Many of these deals are bad.
But yeah,
I was out with dinner with a guy yesterday. So what do you have to do? He said, I got a SPAC. I said, really? Yeah. Invite him a SPAC. Then about the next day, I said, what are you doing? I have a SPAC.
Wow. If you and I were smart, we would have all figured this out a couple of years ago, and there'd be empty chairs here at this desk.
So we have what's called a contract. And we work for a company, and that company's called Comcast.
Did you have to bring that up?
I just felt like I ought to because I brought up Ford.
It's a great company.
I mentioned Boeing.
The stock is up. It's up. Look at that. 0.5%. By the way, I'm glad I have a contract because I could get fired for talking about that. I'm kidding. I'm kidding.
I think it was B of A yesterday, guys, that pointed out that a basket of Comcast, Altice, and Charter has underperformed the S&P by 30% in the last 3 months.
House of Pain.
It's House of Pain. Yeah. It is. And Verizon, AT&T, and T-Mobile, as we've said, and we did all this yesterday. We don't need to go back over it. Have also been significant underperformers throughout the course of the year. AT&T shares crawling back. They're down 20%.
I was doing a piece on working on dividend aristocrats because you've got Hormel as dividend aristocrat, and AT&T had been on that list, David.
What is a dividend aristocrat?
People
Explain
raise
that
the
to me.
dividend every year.
Okay.
AT&T's not on that. I don't think it'd be on that list this year.
No. That was a key moment of disappointment for you when they cut their dividend as a result of the deal, of course, that they are still pursuing and likely to close in, let's call it, the next 4 or 5 months with Discovery to merge the Warner unit with Discovery.
Well, when do these stocks bottom? At what point do they represent value?
I think there are those who look at Discovery shares right now in terms of what the implied company will be valued at and think that there may be value there, but they're still concerned about the debt level of the company, despite John Malone, for example, coming on and talking about how they're going to be able to delever so quickly and not be as levered as much as might be anticipated, talking about not just cost synergies, but revenue synergies. Nonetheless, leverage plus linear cable network still equals concern.
Well, is there a way that you can, without doing a deal, since the government probably will not favor many deals, where you can reinvent yourself and just come up with a product that is just like Roku? You know, Roku came out of nowhere. I don't know. I mean, something that in your device that's just different from what you thought. I mean, I subscribe to Disney Plus. I subscribe to ESPN Plus because I do fantasy football. Sure, last weekend, obviously. But I'm just saying that something on the drawing board, David.
It's a great point and an interesting question, but oftentimes companies that are the incumbents don't come up with those kinds of significant moves for any variety of reasons, and there have been plenty of books written about it.
Well, you wrote the book about this about 6 months ago, telling people, and I was going to buy one of these stocks from the Charitable Trust. Thank you for pointing out that it's not going to be. And you weren't recommending, so you just told the truth.
No, it's a competitive environment right now, but we'll see what 2022 brings.
I know we just did Oracle, but Jim, 17% gain in Oracle. Stock began the year at $61.
I actually think that Larry does like me, just so you know, because I just think that what matters is that in the end, what he says about who really uses him, and at one point he talks about the hybrid cloud. Everybody loves the hybrid cloud, which is like you're on premise, but then you can do it to one of the cloud companies. We're talking about Google. Yep. Said that he calls it ridiculous. He says that's ridiculous. You want to control the whole thing. So you have a cloud that can't be hacked, that you're in control of with a firewall behind you for Pren, and you also he's offering you a value proposition that's actually irreplaceable. That's why you can see Bank of America, one of the smartest companies in the world, going with him. All the banks. I mean, by the way, the healthcare companies all going with him. It is a tour de force call. Tour de force.
And so how, when we talk about the major cloud providers, obviously AWS and Amazon, and then we've got Microsoft, and then we've got Alphabet, where do you rank Oracle?
Well, I in the verticals that they're in, it's game, set, match. I mean, one of the things that's so hard is that you don't know them. Carl, you mentioned earlier something that's really important. Enterprise. Okay, the enterprise is hidden to most of our viewers, but Oracle is so cheap versus these other stocks. It really makes no sense. Remember that Safra, the great CEO, she says they bought back 47% of the company. Like, remember yesterday you were saying about do buybacks work?
Yeah.
I mean, holy cow! They're doing that. They return so much money in dividends. This is a company that we used to talk about constantly, and we stopped. Now, of course, Mark Hurd passed away.
Yes.
And I had a great working relation with Mark. He always told you about the names.
A real
that
friend
you
of
won.
CNBC.
Real
Safra Catz is
Safra's amazing.
Yeah.
Just incredible. These two, Safra, I do, and I miss Mark because Mark's better. Safra Catz and Larry Ellison are titans, and we don't even. It's like, well, yeah, Oracle. I mean, Oracle's gigantic. Look at that.
Another chief executive you've been very complimentary of has been Adam Aaron.
No, I know.
You knew it.
You know what?
Yeah,
I can read your mind.
Just
like Carson with I'm the great Karnak.
Yeah.
People remember
Does
Carson.
that make me McMahon? I don't know. He sold. I've been talking about it. I'm like, he's just all he can do is wait to sell. Sold another 313,000 shares.
Yeah.
He owns now only 96. I say only, he now owns 96,000 shares of common.
So the CFO
This
sell
after
it
a
all, right?
sale of 313. CFO's done. He's out.
Yeah, but he gets more stuff.
Okay. So he sold 18,000 shares. CFO Sean Goodman owns 0 right now. They were all by 10b5-1 trading plans adopted, as well. But they're managing to monetize, as we knew
but
they
they're
would.
also offering very interesting things that kind of club-like feel when you're a shareholder, right? I mean, free popcorn, nothing yet with NFT.
Free popcorn is
he
definitely
stokes
worth
the
it.
apes, right? He's got the apes
Yeah.
going for him.
He's got a $14.5 billion market value still.
Yeah. Do you think it's probably overvalued versus?
I
Disney
think
had a
that there is a general belief amongst those who follow the company closely in the analyst community that it is vastly overvalued.
And how about GameStop after that terrific call yesterday?
GameStop did not have a great
The call
day
was
yesterday.
the call. They've got to really start running the call. I mean, that call is like MICKUI.
They've been
MOUSC.
unwilling to be as transparent, at least as, if we're going to start comparing meme names.
Well, I'll tell you something. Remember, it's always Ryan Cohen, the co-founder of Chewy. Chewy's quarter wasn't so hot.
No, we haven't done Chewy.
They got
just an EBITDA miss.
Although Singh did a good job, and they do.
He did.
They're getting
We had
more per
him on
customer. They have a
Closing
new
Bell
ARPU
yesterday. The
Yeah,
CEO.
well, they said it was on Mad Money when I watched it. I felt great.
Oh,
but I
yeah, he
didn't have
was, and he was on with Sarah and myself. Yeah.
Well, they said it was on Mad Money.
Well, they were wrong.
But
Q4 revenue guide was basically in line. Nothing too fancy.
No, but look, I mean, Chewy's, it's not being hurt. It's taking customers, but you never want to hear that they got a supply chain issue. Now, was it? Look, they're very transparent, and they're getting more per customer. I thought that mattered. Great. Was it better than Lulu in terms of bad call of the night?
I don't
know. Mirror on the
Lulu's
wall.
only down 1%. Lulu has, it is.
Well, it's just Mirror. Everything else was
Lulu
good.
is valued at a multiple to revenues that is extraordinary for any company,
Yeah.
let alone a retailer.
But
many say that it is well deserved given what this company's been able to
Mirror's
accomplish.
not doing that.
And its $54 billion market value.
With it, all the clothing was doing well, but people were really focused on Mirror, their acquisition, and how it may not be working. Sales expectations lower. They did talk it down. Now, I bought the Mirror as a surprise for my daughter who doesn't watch the show. And it comes in like these giant pieces, and you got to have someone you have to have someone stay at home. You're ready for it, and it's like it's sitting in my. I'm not doing anything with it, dude. It's so big. It's like I don't want to do it. Mirror, cracked mirror, black mirror. Mirror on the wall.
They've got that dispute over Mirror with Peloton, which today.
Oh my God! Did you see that Peloton
today
piece?
Gets cut by CS. They go to neutral, target 50. That's basically cutting their target in half. And Peloton close to a 3 handle now, Jim.
Wow. Well, the key area that seems like a guy having a heart attack on Peloton.
Spoiler
yes,
alert.
it's a spoiler,
Spoiler
which
alert.
I don't think the company has addressed.
No.
Maybe they had a statement.
No, I don't know. But look,
Yeah, my wife watched that last night. I'm like, really? They killed him off in the first episode?
You're not supposed to. It's a spoiler, David.
I don't care. Don't watch it anyway. It's really not
Well,
good.
I think that the downgrade had a lot to be desired, because I think that you would have liked that from Foley a little earlier there. John Foley, by the way, is a great competitor, and I don't want to just denigrate the guy. And it is a remarkable thing. But look, the pandemic kind of ran its course, and a lot of the people who were on their exercise like classes, and a lot of people want to go out, and Planet Fitness doing better. And what do you what?
Well, the pandemic could run its course. There's some people that might disagree with that.
No, okay. Let me put it another way. That people are accepting the risk of the pandemic, and they're going back to Planet Fitness, which is doing quite well.
By the way, the other downgrade of note is Southwest. Jim, of course, talked to Gary Kelly and Jordan yesterday. Close to 42. Goldman goes to sell. Their general point, Jim, is they're going to spend a lot more on technology, above average industry cost, and a longer path to pre-COVID profitability.
Well, they had an analyst day, and you got 3 analysts saying bad things. Now, obviously, Gary Kelly's stepping up the chairmanship, but I don't think that it's worth betting against Southwest down here. It's a pretty good company, but they do have some labor issues. They do have to spend more. All the airlines have to spend a lot on technology, because these things, Southwest is good customer service, but the customer service these days is web. It's you get the United. Have you been? Are you member of the United Club?
No.
It's really good.
Is it?
Yeah, it's just fantastic. Spend a lot of money on tech there.
We should quickly do Moderna.
Yes.
On some flu vaccine data that I guess did not impress the market, Jim. The volatility in this particular name remains remarkable.
Monster short position. It's one of those things where it's very hard to figure out the terminal value. I mean, if a company has all this cash, they have to develop these personalized cancer vaccines in order to be able to justify this
because valuation, right?
Right.
I mean, again,
because you can't just have. Remember, Pfizer's got this giant pipe, and they have some loss of exclusivity drugs that this is going to tide them over. Moderna is it's not one shot, but. That's literally one shot.
Been cut in half. I mean, at one point, I remember it was challenging Merck in terms of market value.
Are you going to go up Zoom?
Now Moderna's market value is below $100 billion. It's still a very large company, and obviously the stock has still been an incredible performer. Even over the last 12 months, it's still up nicely.
Well, I love Mansell, and I think he's going to be able to pull off more than people realize.
Mm-hmm.
But, geez, that stock got way too hot.
It's easy to say now, isn't it?
Well, yeah. Oh, you mean second guessing person? Okay.
Not that you were never a big proponent.
No,
you were never.
I like Pfizer because Pfizer has so much going.
Yeah,
Pfizer's a good company.
We should mention we talked to Oracle, Cisco, and Salesforce are both leading the Dow. There is a report, Jim, that Microsoft is going to get clearance on Nuance in the EU.
Yeah,
$16 billion.
A lot of people feel they paid too much for Nuance. I think. I'm not going against what that company does, but Salesforce
People
had
still waiting for that close, and obviously the other one is AMD and Xilinx.
Salesforce had a very positive meeting, and Mark Benioff was in town, and what he's saying is, Slack is very, very good. You know what else is Benioff gets mentioned on the Oracle call, and there are people who didn't like the Benioff guidance. Remember, he was doing 82 cents and he cut down to 72 cents. And he's blamed the dollar.
I'm glad we're in the Benioff part of the show now. Well, we did the Farley part of the show.
That's a good
I want to talk about Microsoft, and you can't help yourself. You just got to talk about Salesforce.
I feel like crying.
Where's our Jensen? We should just have segments titled.
Okay, you want that? There's a complete. There's a report out today about who are the winners in the Omniverse, Metaverse, and talk about Roblox, of course. Where is? There's not even a plaque. There's not a monument for Jensen in that piece. So it's getting hit.
It's not really getting hit. It's down.
Stock's getting hit.
Down fractionally.
Well, I was going to say that Larry Ellison talked about how the dollar got so strong. Now, when that it did curtail some of the enthusiasm. When Benioff said that in the conference call, people ignored it and said, geez, obviously business is weaker. Didn't say that about Oracle. Mark did have he's been having these very interesting salon dinners. He had Yo-Yo Ma the other day. Wow. When I was a freshman at college, I went to Yo-Yo Ma and I said, well, I guess that area's done. That guy's done. There was never going to be another guy like him. It's like a soft.
So he had him in person, or was that in the meta? That wasn't in the metaverse.
But you have to have PCR.
You have to have a PCR test to see Yo-Yo Ma.
Yes.
In
No,
person
no, to
at
go
Mark
to the
Benioff's
dinners.
office.
Right. Mark Lane.
Yes.
Yeah.
These days, everybody's got a test for everything. By the way, testing is much easier, thankfully.
Yeah, you can
I've seen ads for Binax everywhere. Right?
Yeah, Binax and the stock continues to do very, very well as people realize that, wait a second, you got to test regularly because you don't know who has it. And everyone thinks that they're gouging. That's not right. They haven't raised the price. And it's just that in Europe, in London, you get it free. They give it to you free in UK. Here they charge.
Well, the testing here in the vans on this is free.
I do. I love the concierge.
Yeah. But no, right? I mean,
concierge van.
Once you get
comes
your
to you.
QR code, you just go up and get tested. Boom.
We test you. I like it.
Yeah. Guys, we're hanging on to 4,700 roughly. Dow's up 175, even with all the hand-wringing about CPI. Let's get to Bob Pisani. Hey, Bob.
Yeah, we're up nicely and holding the gains. It's not a huge rally, but it's a very broad rally. What does that mean? I always get asked, what does that mean, broad rally? Well, 4-1 advancing to declining stocks. That's a broad rally. More importantly, it's broad in terms stylistically, in terms of sectors. You have growth like technology stocks. Semi's having a great morning. Broadcom's up like $50, like close to 10%. It had a great report, $10 billion buyback. It's just killing it, all cylinders there. Energy started up, is now flattish, but there's materials. So you get sectors that have cyclical characteristics, consumer staples, which are defensive characteristics up. That's a broad rally. Transports are a little bit not participating as much because the airlines are a little weaker today. But by and large, the airlines have had a pretty good week. So where are we right now? The headline on the CPI, okay, we know what the headline is going to be, 6.8%. That'll be screaming. It's not great, but it's not unexpected. And the key thing about, and why you're seeing this market reaction, this is a completely different market than 2 weeks ago. Because the Fed has already become more hawkish. The Fed has moved in advance of the market. Had the Fed done nothing, we would not be seeing the market looking like this. So what's happened? Short-term yields have already moved up. What else has happened? The dollar has already moved up. What else? Emerging market stocks have moved down. That's a very typical reaction. And we've seen speculative tech, Cathie Wood stuff, crypto, already weaker. The market's different than it was 2 weeks ago. So give Jay Powell a little credit here. What else is going on here? You notice this bifurcation between big cap tech, mega cap tech actually, and the more speculative stuff. So, look at just from the 52-week high, you can slice and dice this a million different ways, but Apple, Alphabet, Amazon, Nvidia, from 52-week highs, they're not that far off from where they were on 52-week highs. Look at the more speculative tech stocks, stuff associated with Cathie Wood, for example. This is a pretty big difference. Tesla, Coinbase, Spotify, Twilio, Roku, you could go on and on. There's dozens of names here associated with it. But you see the huge bifurcation between mega cap tech and more speculative tech. Big gulf in terms of what investors are willing to keep their money in right now. So where are we? What are we going next? What's going to happen in the next couple of weeks? Obviously, the Fed, and again, give Powell some credit, the tightening has been well telegraphed. And that's why we're getting this market today. Omicron, well, all right, is it more infection, less virulent? This is the narrative we want to believe. The Pfizer news was a really big plus. Fauci, give him some credit. He was right directionally on where the story was going on Omicron so far. I still maintain if that is the correct narrative on Omicron, then the big story for 2022 is not Omicron. The big story will become how strong will the consumer remain? Not in January. How strong is the consumer, Carl, going to be in June, July, August, September next year? That's the big question that we're going to have to deal with. And we're all going to be talking about that come January. Carl, back to you.
As we go to break, let's take a look at how treasuries are faring this morning. Obviously, hugely important CPI print today. And the consensus largely got it right. Some taking some solace in the core, up 0.5. Prior months was 0.6. You got the 10-year back to 147. And on a real basis, got lowest levels in several years. Dow's up 154. We'll be right back. A reminder, you can always get in on the new CNBC Investing Club with Jim, especially on the heels of his event yesterday, which was fabulous. Go to cnbc.com/investing club or use the QR code on the screen. It takes you right there. Hanging on to some pretty steady gains, at least in the first half hour of trade, 46.92. We're back in a moment. Let's get to Jim and stop trading.
Carl, Cowen's been doing a couple of really great pieces, best ideas for 2022. My favorite so far is Oliver Chen today, talking about Macy's. If you look at Macy's from the summer, it went all the way up because they announced this great, that they're thinking about doing this terrific initiative. They've got great Omni, great third-party marketplace, growing loyalty program. So this may be the level to get back in. You've sidestepped a gigantic move up as people got very excited about the idea of spinning off the .com, so to speak. But this is a good level. Jeff Gannett's working very hard for you. I think you're going to have a good holiday season. I like this call very, very much.
How about tonight?
Look, I'm possessed by housing, and there's a company called AZEK that makes the decking that I use. I don't know if you know it. Jesse Singh was terrific executive 3M. Now he's running this. He's doing an amazing job at AZEK. And what I want to do is get the temperature of people who are putting new decks down. Everything in a home. You can't. This man's putting up factories, trying to keep up with demand. This is some country right now. Wow. Demand and everything, even cream cheese.
Yes, thankfully, perhaps not a shortage.
That would be devastating. I'm from Philadelphia. That would say a lot about us.
There you go.
Yes, you are.
That's where all the cream cheese comes from.
Jim, we'll see you tonight.
Great show, guys.
Good week. Mad Money, 6 p.m. Eastern time. When we come back, White House reaction to this morning's CPI data. We'll talk with the chair of the President's Council of Economic Advisors, Cecilia Rouse. Dow's up 114. Good Friday morning. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with Morgan Brennan and David Faber, live at Post 9 at the New York Stock Exchange. Markets hanging on to some gains as CPI year on year is the highest since June of '82, but it does look like consensus got us ready for it, and yields actually came down on that news. Meantime, consumer sentiment out a few moments ago. Rick Santelli's got it. Rick?
Yes, these are December preliminary numbers. 70.0, 70.4 is the preliminary sentiment headline number. Sequentially, of course, that follows last month's final read at 67.4. So it is definitely much better. And if we look through the expectations and current conditions, what we see is current conditions, 74.6, much better than we were looking for, 73.6 in the rearview mirror. If we look at what lies ahead, 67.8, a nice jump versus our final last month read at 63.5. Now, the money numbers, many pay more attention now to the inflation aspects. The one-year outlook for University of Michigan survey respondents, 4.9. It stays at 4.9. This is a 13-year high, second month in a row. This is preliminary, I remind you. And on the 5 to 10-year inflation outlook, it remains at 3%. This is like the fourth 3% reading. To find a higher reading than 3%, you have to go back 10 years. So once again, just like CPI, the year over year on CPI and these 1 and 5 to 10 year remain very sticky with regard to inflation. Morgan, back to you.
Rick Santelli, thank you. We are 30 minutes into the trading session. Here are three big movers that we are watching this morning. We're going to start with shares of Lululemon. Lower, despite beating on both the top and bottom lines. The company warning that new COVID variants could impact demand. You can see those shares are down 2% right now, plus Chewy shares getting crushed. After reporting a wider than expected quarterly loss, that stock is down about 7.5% right now. It's down 42% year to date. And we will end with Peloton getting downgraded to neutral from outperformer Credit Suisse, with the firm noting a number of headwinds for the company, including a return to out-of-home fitness. But David and Carl, plug your ears, earmuffs, viewers who are Sex and the City fans, for my spoiler alert here. The new Revival show, and Just Like That, which kills off Mr. Big with a heart attack after riding his Peloton, which created a huge Twitter frenzy yesterday, actually elicited a response from the company. Can't be helping shares here either, which are down about 2.5%, 3%. David?
Yeah, that was actually on in my house last night, Morgan. And I couldn't watch. I couldn't watch Mr. Big. Come on. How could they do that to him?
Right?
Yeah. All right. Inflation rising to 6.8%. That is the highest rate since 1982. It's putting pressure on the economic recovery, perhaps. And of course, well, all eyes, Steve Leisman, continue to be on the Fed. My eyes, your eyes. What do you think?
Where else would you look, David? I mean, the November report underscores three important and worrisome parts of the inflation story. It's rising, it's persistent, and it's widespread. The 6.8% headline, just given to you by the one and only David Faber, just a bit over expectations, marked the highest rate of the CPI since '82. But even when you take out food and energy, the core rate is continuing to rise. That's at 4.9% year over year, the highest level since 1991. The key is that it's not just energy or food, both of which are up strongly this year. Apparel's up 5% year over year. Used car prices up 31%. The rising cost of housing belatedly now working into the CPI, as are higher wages. You can see by looking at the service sector ex energy, up 3.5%. And there could be more to come. Yet markets appeared to be braced for this report, and maybe even worse. Yields fell on the news and stocks rallied, at least for now. There was little change in the outlook for the Fed, which has positioned itself, or at least in its rhetoric in the last several weeks, to being more concerned about inflation and ready now to act to counter it. Markets continue to expect the first rate hike in May, a second one in September, and you can see the third one just about priced in for December. But that positions the Fed for the current level and the current inflation outlook. If more housing or wage price gains work into the index and inflation does not cool by the summer, that outlook for rate hikes could turn more hawkish yet again. Morgan?
And we're going to be watching all of that. Steve, thank you for bringing us the latest. Steve Leisman joining us now, as Wells Fargo Investment Institute Senior Global Market Strategist Samir Samana and Truist Advisory Services CIO Keith Lerner to continue to dig into this conversation. Gentlemen, good morning to you both. Samir, I'll start with you. I mean, we did have this hot inflation read, right? Fastest pace in almost 40 years, and yet equities are higher, treasury yields are ticking lower. Was this already priced into the market? How do you see this, I guess, adding to or shifting, if it does at all, your investment thesis as we go into another year?
It was somewhat expected, and that's why you are seeing, especially the long end of the bond curve, start to do well in terms of yields falling and prices rising. This is kind of the market giving the Fed a green light to start to begin to raise interest rates. And what they're basically telling the Fed is you're on the right path with respect to tapering a little bit faster and at least thinking about rate increases, because that long end of the curve is probably the part that's most sensitive to inflation expectations. And so the fact that it's doing well tells us that the market was ready for this.
Keith, do you see it the same way? The market giving the Fed a green light here?
First, good morning. I think the way I look at this is, markets are all about expectations, and this came in relative to expectations. And there were some whisper numbers that it could be even worse. So I think that's why the market so far has reacted okay. As far as the more direct question on the Fed, this definitely allows them to move forward with even a more accelerated taper. I will say, though, right now the market's starting to price in 3 rate hikes. We think that's too aggressive, especially where you consider with the 10-year below 150. If they want to preserve any type of yield curves, I think they're going to go at a more cautious pace. And I think 6 months from now, while inflation will likely stay somewhat elevated, it will start to decelerate as we go lap over year comps.
So, Keith, then how should investors be positioned next year?
Our view, we've been very bullish over the last 2 years, and we're still positive, but we're also realistic that after this big bull market, after we've seen this rebound in valuations and earnings, that we're going to just grow at a more modest pace. But as we look at next year, as far as position, we still are favorable on equities relative to fixed income and cash. From a sector strategy, we have more of a barbell strategy because we think we're going to have this kind of back and forth between is the Fed going too fast or too slow, new variants come in. So we like areas like technology, which is doing well today. And then we also like cyclical areas like energy and financials. Definitely like the U.S. as the big blue chip country and see that as more favorable relative to international. And we're more negative on emerging markets as we head to next year. And we've been more negative this year in general.
So, Samir, what do you see as the biggest risks to the market as we head into 2022? And what does that mean for the way you're counseling investors to be positioned too?
Yeah, look, the biggest risk probably does remain the Fed and the possibility that they may end up making a policy mistake of some kind. And, we think the probabilities of that are very low. But when we look at, our numbers for next year, the forecast, and we look at other people's forecasts for next year, I think that's probably the biggest distinction is there's a lot of people who are kind of baking a Fed policy mistake in as their base case. And we are just not in that camp. And so we remain pretty constructive because we think the Fed will, get this right. And so, we like stocks. We think there's another solid year next year. We've got a 5,200 target on the S&P. So that's almost a 13% total return from current levels. We like U.S. equities. We like large. We like mids. We also like tech, communication services, financials, and industrial. So a good mix of, cyclicals and growth. Kind of the way we've been, telling investors to position is, kind of the tagline is, stocks over bonds and anything but defensive.
Okay, we'll leave the conversation there. Thank you, gentlemen, for kicking off the hour with us, Samir and Keith.
Thank you.
Staying with the markets and this morning's inflation data, here with the first response from the Biden administration is Cecilia Rouse, chair of the Council of Economic Advisors. Madam Chair, good to have you. Thanks for being with us this morning.
Good morning.
I saw yesterday that Brian Deese wouldn't predict what would happen to prices next year, but there is a view somewhat on Wall Street that headline might be peaking here. I'll give you a chance to let us know whether or not you agree.
Well, look, if we consider the economy as a whole, we know that our unemployment rate has roared down, I guess I would say, to 4.2%, that this has been one of the fastest labor market recoveries following a downturn. So we are optimistic that the recovery continues to heal going into 2022. And so with that, I think that inflation will come down over the coming months. Obviously, that will depend on a number of things, but we are working hard to ease supply chain challenges. We're working hard to address any bottlenecks we may see. But importantly, we believe that as we get to the other side of this pandemic, obviously that's at the control of the virus, but as we work hard to get vaccinations into arms, as we vaccinate the rest of the world, that the economies around the world will heal and we will see inflation pressures ease.
So when you think about the pandemic and any relief we might get next year, let's all hope so, do you see it as hawkish because it will restore even more demand, or dovish perhaps because supply might continue to be challenged in that case?
Well, there are two sides to the market, and I think that's a very good point. And I see it more as that the market comes back into equilibrium. The demand right now, what we have is demand outstripping supply. We know that actually when it comes to global supply, that the throughput at our ports is higher than ever. Well, maybe not never, but it's higher than pre-pandemic, and that consumers are buying goods. And so what I believe it will be coming is more just that the demand and supply will equilibrate. So it's both. So, obviously we hope that happens in tandem so that we don't have further hiccups along the way. But that's how I'm thinking about it.
Morgan, just to dig into that a little bit, I mean, I think across the board, economists, Wall Street strategists all expect inflation to come down from these elevated levels next year as we do see the worst of coronavirus and supply chain bottlenecks, et cetera, subside. But for the administration specifically, come down to what? What would be an acceptable level of inflation?
Well, the Fed has set a target of on average about 2%. But I think it's important that from this administration's perspective, the president's really focused on increasing economic capacity writ large. That's the foundation of the infrastructure jobs law that was just passed. That's the foundation of the Build Back Better plan that's with the Senate, and we hope will pass Congress soon. And that really tries to increase economic capacity by getting people back to work, which helps on our labor supply front. So the point is to build economic capacity so that the economy better, that's the way to ease inflationary pressure going forward. So that's really what the administration's focused on, because that's so important for our economic health going forward.
Yeah, supply chain issues we certainly could imagine will help ameliorate some of the cost increases that we've seen. But what about food and what about shelter? Obviously, the two things that are very key to sort of living. What are your expectations there, given what have been significant moves up for both?
Yeah, no, that's a fair point. And, with food, the administration has been focused on concentration in the food industry. Some of that also comes from environmental challenges around the world. And some of it is about energy prices. And as energy prices are starting to ameliorate, we expect to see some of that show up in food prices as well. Housing is as a challenge. We've had a long-term, challenge on the supply side of housing ever since the financial downturn of 2008, 2009. And again, as part of the Build Back Better plan, there's an effort to put more investments into our housing sector, because that is a challenge. We know it's a challenge. It was exacerbated in the pandemic, and we know it needs to be addressed.
When you look at inflation expectations for, say, 5 or 10 years, they've crept up, but they're nowhere. I mean, they're not as bad as they were, say, in 2013 or 2014. I wonder if you think that's because people have confidence in the Fed, or do they look at long-term demographics in this country, or are they convinced that productivity and corporate capex is going to keep a tight leash on inflation? What do you think's driving that longer-term confidence in inflation expectation?
Well, I think it's both and. I think as one is the immediate past experience, going back, when I say immediate, okay, so I'm showing my age here, going back, 10, 20 years, we haven't seen inflation pop in the way that it did in the early 70s, early 80s. I know that's the concern of many, but we have seen that, even after many people were expecting inflation after the Great Recession, we didn't see that materialize. We do have confidence that the Fed has the tools to address inflation, to achieve its goals for inflation, which again, the Fed was actually struggling with too low inflation. Interest rates were too low, which meant that it didn't have room to do at least traditional monetary policy. So, we have the confidence that the Fed can achieve its monetary goals. And, we just believe that with the investments that we're making, both on the physical infrastructure and in human infrastructure, in our human capital, that we'll have the economic capacity that our economy can, better absorb and ease inflationary pressure with increased. That's through increased productivity. It's not by stoking demand. So that's why economists agree that Build Back Better does not add to inflationary pressure. It's it's investment over the longer term, and that's by really building the productive capacity of our economy.
How are you going to approach tariffs? I mean, Treasury Secretary Yellen just earlier this month actually admitted that the Trump-era tariffs on some imported goods from China, if we were to lower those or lift those altogether, that could help with some of these inflationary pressures. Is that something that's on the table for the administration?
So the administration is doing a comprehensive review of the tariffs. What is the economic rationale for having them in place? Are they there for achieving other goals? And again, this administration, this president is focused on trying to ease price pressures and is looking at every tool in the toolbox.
Chair Russ, I heard you mention Build Back Better and your contention it won't raise inflation. It seems to be a significant concern of one senator named Joe Manchin. I don't know if you've had a chance to speak with him directly, but what would be the arguments that you make to him to try to get his vote?
Well, I would make 3 points to him. One is that if we actually look at the federal spending for this fiscal year 2022, we are facing significant fiscal headwinds. There is a fiscal drag that we haven't seen since the end of World War II in this fiscal year. So the Build Back Better plan does not contribute to that. That the fiscal drag of about 8.5 percentage points of GDP growth does not. That is with the Build Back Better plan and the infrastructure bill built in. Two, I would point out that these are investments. They spend out over time. This is not like the stimulus, the rescue plan, where we needed to get money into the economy quickly. These are meant to be spent over time. And thirdly, I would point out that they're meant to be increasing the productive capacity of our economy. All three of those mean that this is not going to increase inflation in the short term. And, economists widely agree on this point.
Hey, finally, Cecilia, yesterday the president made some news by arguing that today's print would not reflect some of the decreases we've seen in, say, energy costs. Does the White House believe that will be captured in the December print?
Well, what we know is that since these data were collected, we've seen some moderation in natural gas and in oil prices. And so, as the data are collected for the December print, we would expect to see those decreases reflected then.
Thanks so much for your time. Obviously, a huge story for the markets, and we love having you on. Thank you very much, Cecilia Rouse.
Thank you very much. Bye.
As we go to break, take a look at the roadmap for the rest of the hour, including some shade in the cloud. Oracle's Larry Ellison taking a swipe at his competitors on yesterday's earnings call.
Plus, Moderna shares, they are down rather sharply this after posting data from its early flu vaccine study. The stock, by the way, now down 30% just since the start of the month.
And Starbucks employees at a Buffalo store location voting to unionize. A first for the coffee chain giant. And we've got those details. A lot more squawk on the street straight ahead.
let me close with a note that I'm going to paraphrase from a very large telecommunications company who uses our cloud and all the other three North American clouds, Google, Amazon, and Microsoft. And the note basically said, the one thing we've noticed about Oracle's cloud, is that it never, ever goes down. We can't say that about any of the other clouds.
That was Oracle's chairman, Larry Ellison, last night on the company's earnings call, taking a bit of a jab at the competition, including, of course, Amazon Web Services in the wake of a recent outage. Oracle shares, well, they are up sharply this after the company did beat on estimates driven by cloud revenue. Our next guest raising his price target on the stock, Wolf Research analyst Alex Zukin joins us. Yeah, Alex, I was going to ask you about your price target, which had been 95. How about the quarter itself? Is that leading you perhaps to consider raising your rating, which I think says here you're at a hold?
Yeah, hey, thanks for the question, and happy holidays to you and all your listeners. I think that, look, it was a very strong quarter. It was a very strong quarter at a time when not everybody was having a strong quarter. And I think it was vintage Larry. It's the power of the apps. I think, there's easier competition out there than AWS, and it's some of the other ERP companies. And I think you saw that. This is a company, again, that they sort of invented the notion of the cloud at the same time as, famously declaring that it was not going to work for large enterprise organizations. The thing that stood out to us, again, the continued momentum of ERP in the cloud. This is an area that Oracle is, among best in class. And it's, less than a quarter of their revenue, but we think it's more than 80% or close to 80% of their incremental growth dollars. And we believe that, next year, coming out of the pandemic was a forcing function, a Y2K event, if you will, for back office transformations. And we believe that that's just going to accelerate next year, as a lot of companies are, faced not just with supply chain shortages, not just with a war on talent, but just a completely different configuration of their entire organization. So,
yeah,
given
all that, I'm just curious, and the momentum that you just described, from your point of view, what is holding you back then, or what is giving you pause that you continue to have a hold rating on the stock?
So, look, we cover a lot of growth companies, and we believe that Oracle is now getting into a mode where they're starting to execute effectively. For us, it's time. We've covered Oracle for a number of years. There have been false starts before. So we want to be patient. We want to see, the second half is the most important for typical enterprise software companies. They're going into their third quarter. They're going into their fourth quarter. We want to see how they execute and if they can keep up the momentum. And if they can, the stock is still trading below the S&P on an earnings multiple in this year. And I think that's kind of interesting.
Alex, do we fully appreciate, or do investors fully appreciate the opportunity for a company like Oracle, or by the way, Amazon or Microsoft or some of the others, where government contracting work is concerned right now?
I think it's a very interesting question. Look, we're in an era of meme stocks and Wall Street bets. And one thing that investors, particularly large tech investors, love is an old dog that learns new tricks. And Oracle, you can see the pathway that Microsoft laid many years ago when they really embraced and transitioned fully to the cloud. That's the kind of pattern that Oracle wants investors to think about when looking at the opportunity they have. In fact, Larry referenced how Microsoft moved their office space into the cloud and how the company now is moving its base of large application on-prem customers, and they only moved 1,000 out of 8,500 in the next 5 to 10 years. There's an opportunity to move the rest. That's a pattern recognition that can potentially be pretty powerful. And if investors start to gain confidence in the durability of this growth and the opportunity for it to be more profitable and see more earnings power, the sky's the limit.
Yeah, so here's some wait and see, given the fact that you do have a hold rating on Oracle right now. What would you buy instead if you could choose one or two names?
Yeah, we have a mnemonic. We call it Catwoman. The C stands for Salesforce. The A is Adobe. The T has been Twilio, W, Workday. and Microsoft eyed into it, and ServiceNow. It's just really this next generation breed of cloud companies where we think you can benefit from really high level management, great markets, and really powerful margins.
Alex, thank you. Appreciate your time.
Thank you, guys.
Before the break, take a closer look at Moderna today. Big drop following that flu vaccine study. Stock's down $120 in the first 10 days of the month so far. We're back in 2 minutes.
Hey guys, yesterday we said, someone said,
Welcome back. I'm Rahel Solomon, and here is.
If you can help me. So this is what I did yesterday. I received the account under 500, and now we have the account double in 24 hours. So now he have, like, I believe yesterday it was 480. Today we did a lot of trade. We did minus $7, minus 20, minus plus 23, plus 23, plus 46, plus 14, 45, 93, 48, 220, and 25. So we did almost double the account in 24 hours. So I hope you can double your account every day. I'm not expecting to double the account every day. I'm just trying to help you whatever I can. So at least you have good amount today you can start with, and you can follow my trade. So if you guys have any trouble, you can follow my trade, and I hope you will make money. If you don't like my trade, don't take it. But if it makes sense to you, take it. And you can see we went from 500 480 to 900, we almost doubled the account overnight. That's it for today, and have a good day, everyone, and have a nice weekend. Take care.